Good morning. It is Monday, December 19th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Sozzi. We're not seeing much change in futures this morning, which is interesting because overnight they really took a round trip. They were seeing more of a gain and then have come back to the unchanged level here. And the other averages, we're seeing some similar action here this morning, or lack thereof, I guess. But we're certainly watching other asset classes as well, as we see S&P futures just up a little more than a point, Brad.
That's right. Well, Bitcoin and other cryptocurrencies this morning, we're tracking those, and our top 3 things you need to know this morning. Those cryptocurrencies this morning are mixed right now, but Bitcoin is at least higher by a little bit after Senator Sherrod Brown's comments on Meet the Press over the weekend, where he floated the idea of possibly banning crypto in the U.S. here.
Yeah,
And we're going to have more on that because we had some interesting discussions that took place last week on our air as well. But with regard to everything that we've been tracking with crypto, regarding the particular move around Binance, of course, last week, just to bring everybody up to speed in the context here, was the pausing of some of those withdrawals. And now you have this further of a dampening in some of the sentiment around cryptocurrency. And it's a larger question of where some of the regulation will actually lead back to any type of source of positivity for those who still wanted to have or hold crypto within their own portfolio, whether that be a company or whether that be an individual retail trader as well.
And then, Julie, you flagged too Binance out here coming out here this morning, buying up the bankrupt assets of Voyager Digital. And my first thought was, wow, this is the same strategy that FTX employed, and look what happened to that.
Yeah, no, there are still a lot more questions than answers, which is why we are seeing investors kind of pull back from the space wholesale. There are a couple of items of news this morning, including the fact that Binance is going to be buying the assets of Voyager Digital, which is one of the companies that filed for bankruptcy. And it looks like they're going to be paying a little more than $1 billion for that purchase. There were questions over who was going to get that in auction, but there's now questions about how Binance is going to pay for that, what kind of assets it has at its disposal right now. So that's something else that we continue to watch, even as the Binance coin has been recovering, as you can see, a little bit after sliding pretty precipitously over the past couple of days. It's bounced.
And a little bit lost, I think, in all of this continues to be what the average investor, where is their mind right now? And we were talking in the morning meeting about that really good Wall Street Journal piece over the weekend, profiling a lot of just average investors that got in near the top in cryptocurrencies and now have seen their investments cut in half. And you have some dumping here for huge losses, and you have others continuing to believe in the blockchain technology and perhaps seeing their investments come back at some point.
Well, the critical thing there, too, is in so many of the retail portfolios that may be holding on to cryptocurrency, or even looking at the prices continue to decline, or at least just hover around this $18,000, $17,000 level, and largely look at the buying opportunity, even if they did want to get in. A lot of people going into a potential recession, or depending upon how deep that recession is, are not going to have the same spending power that some of the larger companies that have typically set their positions in the past would do so when there is that decline, not just in price, but also in the economic environment too. And that's exactly where many retail traders, some of those profiled, will find themselves right now, not only just taking the losses that they've already had to mark down, but then additionally not having the opportunity to even buy in at some of the lower levels, even if they were to.
Yeah, but a lot of them are pulling their money out. That journal piece that you mentioned, Saz, I'm citing some data from a company called Crypto Compare that crypto fund asset managers said investors withdrew almost $20 billion in November, which is about 15% of the total assets under management. So even as there's the old saw in finance, don't try to catch a falling knife, right? But people have even been selling into the declines that we've been seeing in crypto, which is continuing to sell, which is quite interesting.
I can't think of anything that I would want to do less than trying to catch a knife that is falling. I just always like that saying.
It's a good saying.
It works. I can visualize it.
There's one more piece of news I want to mention this morning, which is Michael Sonnenschein, the CEO of Grayscale, is out with a letter to investors. It's his first since earlier this year, and the first time we've heard from him since FTX imploded, right? And among other things that he's talking about, besides just the dismal sentiment in crypto right now, is that Grayscale might do a tender offer to investors if the SEC does not approve the spot Bitcoin ETF that Grayscale has been pushing for basically since its inception. And the whole idea behind the Grayscale Bitcoin Trust is that eventually it would be an ETF. It wouldn't just be a trust, right? The structure of which it is now. And so if that didn't succeed, that push, this tender offer could be for up to 20% of the outstanding shares of the company. So I'm going to talk to Michael Sonnenschein later on this morning at around 11:30 and talk to him more about the prospects for the spot Bitcoin ETF, because right now in this environment, I don't know. If it wasn't looking good before, it feels like it's not looking good now.
All right, let's stay on all things weird here to kick off this week. The people have spoken. Elon Musk's Twitter poll closed this morning, and where he asked users over the weekend whether or not he should step down as the CEO of the platform, promising he'll abide by the results. Well, the results are in, folks, and Musk has a history of following through on Twitter polls. You can see the result of that poll. Overwhelming amount of Twitter users, 17.5 million votes on this, say that he should step down as Twitter. Now, we're seeing Tesla shares pop in reaction in the pre-market. Sentiment is clear. Tesla investors want to see a more focused Elon Musk, and that might mean that he has to just hand over the reins to someone else at Twitter, whoever that might be.
He has a history of following through on Twitter polls, but not all of it is directly because of the result of the poll itself. Some of it is premeditated and already a decisive course of action that perhaps he's already mulled over and has decided himself to take even before presenting it to the public. Some of that has been share sales in the past, or even, just making different upgrades to some of the different technology within Tesla vehicles. But for Tesla shareholders, they have been upset by about how much of a headwind that this has proven to be, just the amount of time and the spectacle of Twitter.
And just quickly here, this is unlikely to happen today. This guy just spent $44 billion to buy an asset like this. In an ideal case, he will have laid out a framework, some form of management framework to who lead this company. I wouldn't expect to see an SEC release at some point today saying he's stepping down as Twitter. I couldn't imagine.
You wouldn't have to put out an SEC release, remember?
Well, you would have to put out
It's
something.
a private company.
Okay.
You don't have to do anything. That's the joy of the joy and pain. He would not have to file with the FCC for a management change.
Isn't there debt publicly traded? The debt.
I don't think you would have to file.
Fair point.
I don't think he would. He would probably tweet about it. Listen, he's not going to put a poll out there unless he wants to do it. It's not like he's leaving it up to the users of Twitter whether he's going to step down or not. Is he maybe polling the Tesla board, or maybe they're pushing him in a particular direction? Maybe. I mean, we don't know what's happening behind closed doors there.
He can't do anything at Twitter. I don't think he could transform the platform if he has his investments at Tesla continuing to be under pressure. I mean, the stock is down before this 23%. In December alone, 65% year to date. Anything that he wants to do at Twitter is going to be funded by his investments in Tesla, which have lost massive value.
Well, and he keeps saying he's not going to sell any more shares, and then he keeps selling more shares because of what's going on at Twitter as well. There is some analyst commentary, by the way, out today. Even before that poll, it looks like this preceded that Oppenheimer is downgrading the stock to perform because of Twitter and because of the risks over at Twitter. A friend of the show, Colin Rush, over there, coming out and saying he's increasingly isolated as the steward of Twitter's finances with his user management on the platform. That is what he is saying of Musk, and that there is a negative feedback loop from departures of Twitter advertisers and users due to inconsistent standards. That results in these increased financing needs that may lead to incremental Tesla sales, just as there's a more competitive environment right now for Tesla. In other words, the timing is not great for Elon Musk to be getting so enmeshed in Twitter.
Comes after Goldman last week, too. Cautious comments as well on Tesla.
And there was also the report from DealBook that you pointed out earlier this morning, Julie, which pointed out or talked about Senator Elizabeth Warren and what she may be taking aim at, most notably with regard to where Musk's actions recently have been shortchanging Tesla, and then additionally talking about the series of conflicts of interest with misappropriation of resources from Tesla, of course, the electric car maker he also runs. But for misappropriation or even conflicts of interest in the past, that has been something that has followed Elon Musk around, even since the acquisition that Tesla made of Solar City, an entity that he co-founded with his cousin. So with all of that in mind, I think even as you get more of, in D.C., more of the congressional kind of focus in on what's taking place, the alignment of his time and his responsibilities, because he still does have a fiduciary interest to shareholders over at Tesla, too. And so that appropriation of time is a considerable effort for someone who's kind of painted themselves as not just the CEO and the CTO, but also the chief marketing officer of Tesla. When you have that much power over a brand, that's also something that investors recognize too.
Why can't he employ something, or maybe he should be looking at something like Berkshire Hathaway, where he appoints CEOs of all his different businesses and he just serves as an executive chairman? I know he's still a young guy, he likes to be in the trenches, but why wouldn't something like that work here? It might. It's just, I don't know if he's thinking about that.
Because he doesn't do anything other than what he wants to do. Like, is there any other model? Like, if you look, that would suggest that he...
I've never seen any half.
Right, exactly. So, who the hell knows? Yeah. At the end of the day, that's the bottom line when it comes to Elon Musk. All right, let's move on to the week ahead. Just ahead of the holidays, investors are in for a hectic economic and earnings lineup, actually, in the week ahead. We've got a PCE on deck and earnings from Nike, FedEx, Micron, and General Mills to consider as well. On the economic front, obviously that PCE number, which comes out later in the week, is the one that the Fed does watch most closely. And that's going to be the personal consumption's expenditures deflator. We are, listen, it's probably going to confirm what we've been seeing already, that there is going to be a slowdown in the increase of inflation, slowdown in the rate of inflation. But still, that's something that the market is going to be queuing in on, even as we're likely to have a relatively low volume week, because people are just kind of sewing up their portfolios on the year and getting away for the holidays.
Yeah, I love that calendar we're showing of things coming up. Nike, that's actually been my take, a little preview a little later on in the show. Some concerns on how that quarter shook out. General Mills, a lot of the results, earnings results from the food players like Campbell's Soup have been very strong, have pushed through price increases. General Mills might also echo that as well. FedEx, we've been talking about FedEx a lot the past 6 months. They've put up a series of real dud-type quarters and outlooks. It's proving time for them. Also, we'll give a great read into how the holiday season has been shaping up. Good to hear from FedEx. Micron, they've been warning the past 2 quarters as well. Chip supply considerations. The wild card here might be a Rite Aid. They have not been performing well, but this flu season has been absolutely awful. And I have seen all of these CVS, Rite Aid, Walgreens. These stores have been absolutely packed from people going in there and getting these flu shots.
Yeah, I'll just follow up on 2 of those. FedEx, primarily, the reduction in forecasts that they had noted at the end of last quarter for air freight and ground shipping, that caught a lot of investors' attention, so we'll see if they can bounce back from what was a dud, as I believe you mentioned.
A zero.
Zero.
An egg.
Quarter. And then Nike as well.
Nothing.
Just briefly there. I was looking at some web traffic results as well for Nike. Web traffic has decreased month over month, and particularly for the most recent month that we have results for, which is November. So depending upon how December shapes out and some of the big drops, the big releases, and that expected to drive even more of the fanfare, the traffic that is cyclical year over year for Nike. We'll see how that shakes out for this. Actually, it won't be in this quarter's results because we're current month. So
cool. I mean, I wasn't impressed by anything by Nike. I was in the mall this weekend. Just nothing really like, I need this.
Well, most of the impressive stuff has already dropped on the sneakers app. It's unavailable. You can't get it. You had to beat the bots. You weren't able to do that. Or if it did make it into store, you had to stand in line to go get it. And
no time for that.
I know where you're at most Mondays through Friday. So
no time for that.
Yeah, exactly.
Yeah, definitely not prioritizing the drops these days.
No.
I'm also going to be watching Micron this week, by the way. That's another one that's out just as another measure of where we are in this chip cycle. We know that things are not good within the chip industry. And if you look at the company's forecast for the first quarter, its fiscal first quarter, its forecast is above where most analysts are at this point. So expectations are pretty low, and this will be a good barometer as to what's going on in that industry.
All right, ton to keep an eye on this week here, and some light volume here that we're expecting too. Coming up, everyone, holiday cheer for you all. Our next guest says the best thing investors can say about 2022 is that it's almost over. We're going to discuss next. Signs of a slowing economy are growing, but the Fed appears to be staying the course, with Chair Jay Powell striking a hawkish tone last week. In short, suggesting we ain't done yet. If the Fed is intent on hiking us into a high unemployment recession, and with markets seemingly on a roller coaster ride to nowhere, how do you play it? Our next guest says a cloudy economic environment might mean good news for high dividend picks. Joining us now, we've got Michael Aroney, who is the State Street Global Advisors Chief Investment Strategist at the U.S. Spider Business. Thank you so much for joining us this morning, Michael. Always a pleasure to get some of your time and insight. So, all right, we had teased this before the break, and you're saying that the best thing about 2022 is that it's almost over. So what do we have to look forward to in 2023?
So I have some good news for you. So it's been well reported that the traditional 60-40 portfolio is on pace to have one of its worst years since 1937 in 85 years. But here's the good news. I looked at the 10 worst years for the 60-40 portfolio, and the following year, in 9 out of 10, the 60-40 portfolio had a positive return on average of 17%. The lone exception was 1930, and then again in 1931, following the market crash and the beginning of the Great Depression. I don't know about all of you there, but it doesn't feel like the Great Depression to me. I happened to be doing some holiday shopping in Boston over the weekend, and the stores were packed. So I think that this is the most anticipated recession, earnings declines, and job losses that I've ever seen. And I actually think the markets may rally once it begins to happen.
Michael, one of your peers over at Morgan Stanley, Mike Wilson, out with a note this morning, talking about an earnings recession that rivals 2008, that potentially happening next year in the markets. U.S. stocks may decline 22%. Is that just too bearish?
I think it is a bit too bearish. And here's the thing. I don't know, maybe it's the holidays. I have the holiday cheer or something. Usually I'm the Grinch. But here's the thing. Since 1950, there's been 11 times where earnings in the calendar year have fallen by 10% or more. Do you know how many times the markets have fallen in those 11 times? Just twice. The only two times, 2001 and 2008. And so Mike Wilson suggesting perhaps that this is like a 2008. I would disagree. I don't think so. 2008, we're coming out of some significant structural imbalances as a result of the housing bubble. And you could also argue back in 2001, it was the TMT bubble bursting. I don't think that's the case we're in this time. I think this is a garden variety recession brought on by higher inflation, a tightening Fed, and more cyclical. It will be short and shallow. And as long as it is, I think markets will look through to the other side and begin to price in a recovery.
The other thing, though, that those two eras had in common, if I'm not mistaken, is something else that you just mentioned. That's the tightening cycle, right? So isn't that something that also typically causes stocks to fall? I guess you just don't think that they'll keep going.
So I think that's right. I think one of the risks is, in fact, if the Fed does break something or goes too far. And I think part of the volatility that we continue to see is that the market keeps having to readjust to where the Fed is headed. But I'm actually optimistic that the Fed will begin to end its tightening cycle in the first quarter. So I think they'll raise rates again in February, possibly on March 22nd, and then I think they'll be done. And when they're done, I think markets will breathe a big sigh of relief.
Analysts are still looking in aggregate for an expected 5.5% growth rate in earnings. Do you think that's too high?
It is too high. It's going to come down. As I said, I think on average, during a recession and a bear market, those earnings kind of typically come down about 14% or so. I would expect that to be the case here. But here again, I would underscore this idea that, since 1950, 11 times this has happened. Only twice has the market declined. Investors are expecting the earnings to fall. We're expecting a recession. We're expecting a tick up in unemployment. I believe when it does in fact happen, markets will begin to expect that monetary policy will get easier. Don't forget, in 2024, we're going to be headed towards a national election. So all of a sudden, Democrats and Republicans will find some common ground in order to ensure that we're not in a recession when voters go to the polls during that time. I know it seems like a long way off, but I guarantee you that there'll be policy to help the economy if it is slowing before that national election. And then finally, I think investors will begin to price in a recovery as a result of those actions. And they'll do it far sooner than when the economic data, earnings data, and job losses kind of bottom in.
So given all that, Michael, is it too early to say go cyclical when it comes to stock investments?
So one of our big themes for next year is to play offense and defense with dividend payers, Julie. And I think that's key here. So I recognize the limitations to my forecasting ability. So should I be wrong, I do expect that in a year like this, when volatility is high and markets are down, dividend payers and growers are outperforming the market pretty considerably. Now, the good news is that if the market were to rebound, as I expect, typically dividend payers and growers have greater upside market capture compared to just low volatility and defensive names. They tend to have more cyclical exposure, things like financials and industrials, for example, and they tend to have more value exposure. When I say more than, I mean more than defensive parts of the market, like utilities and staples, and low volatility stocks. So to us, you get to play offense and defense with dividend payers and dividend growers. And I think that seems like a comfortable spot as we head into the uncertainty of 2023.
All right, we'll leave it there. Michael Aronis over at State Street Global Advisors. Always good to see you, my friend. Have a happy holiday season. We'll talk to you soon.
Thank you. Happy holidays.
Coming up, Moderna is getting an optimistic upgrade from Jefferies. We'll discuss that, plus have the opening bell on Wall Street next. Welcome back. The opening bell is a few minutes away, so let's hit a few hot tickers over on the Yahoo Finance platform. Shares of L3Harris Technologies and Aerojet Rocketdyne in focus after the companies announced that L3Harris has agreed to buy the rocket engine maker in a deal valued at about $4.7 billion or $58 per share. Really interesting deal here, guys. And I encourage everyone, if head over to the L3Harris's investor relations page. Just go through the slide deck they put forward on. I think it just helps you understand how companies think about acquisitions. Aerojet really going to give L3Harris new capabilities in missile propulsion, also going to help boost their space program as well. You have Aerojet, about a $2.5 billion revenue business, close to $7 billion in total backlog, 5,000 employees, 1,500 plus engineers. The only red flag is here, L3Harris, their operating margins usually about 21%. They're saying that Aerojet is at about 12% to 14%, so probably a lot of opportunity for L3Harris to come in here and lift the margins of that business. But again, L3Harris getting capabilities they probably didn't have before.
I mean, I think the saga leading up to this is kind of interesting too. I mean, first this company was agreed to be bought by Lockheed Martin. That was all the way back in December 2020. And then the FTC was going to block it on antitrust grounds, so that didn't go through. Elliott Management took a position in Aerojet in August and was pushing for, maybe something like this, for example. And now this is happening. So it's kind of interesting what has led up to this. So this, in other words, this is a company that has been talked about as being in play for more than 2 years now. And now finally, this is the conclusion of all of that back and forth. And by the way, analysts think that L3 is paying too much for it.
Yeah, they're paying $58 a share for Aerojet Rocketdyne. And it's an all-cash transaction, too. So about $4.7 billion in that, inclusive of some of the net debt. And they're saying that currently they generate, I believe you pointed this out, $2.3 billion in annual revenue right there. So this is really going to be a deal that even sheds more spotlight on what the defense kind of industrial-based spending looks like. And for this deal, I mean, this really puts a cap on a big quarter for what we've seen more broadly in aerospace. One of the larger deals that we were talking about, of course, in a different part of aerospace, was just last week with UAL, or United Airlines, and Boeing, and that landmark deal particularly. And so we'll see what further comes forward in some of the end-of-year deal making too.
Yeah, this is the cost of doing business. I know the market doesn't like this, but to get access to those cushy defense spending programs, this is what you have to pay. To get access to the next great space race, these are the type of premium valuation multiples you're going to have to pay for a company like Aerojet.
Yeah, and it's made some other acquisitions, too, to try and beef up its business overall. L3Harris, in October, agreed to buy Viasat's Tactical Data Links division.
Ooh, sounds cool.
Tactical Data Links.
Feels like I should be wearing a pair of black boots and some kind of black vest or something.
Sure, except you're actually sitting at a computer and,
yes, at a desk,
typing
with a suit
away,
and with makeup on.
wearing your tactical.
And
No, I'm
actually
saying that's what
manufactured
it,
by
because it's
Yahoo.
tactical links.
tactical,
It's
yes. Okay.
it's data.
Gotcha.
It's tactical
fun,
data,
though.
but it's yes, I'm sure it's very exciting. That was about a little less than a $2 billion deal. So yeah, it is interesting always too when you see these down to the wire before the end of the year deals, because we've had a couple of those sneak in here, even though this has been such a lackluster year for deals. There's this little burst of activity.
And really in industrials, and it comes at an interesting time where industrial multiples have surprisingly taken off the past month and a half. Goldman Sachs staying underweight on industrials in their note this morning here, citing some of the valuations that have gone through the roof.
Yeah, we'll see if deals come back to the forefront in 2023, but yeah, it's been a lull this year.
Yeah, as Michael Aroney wrote in his note, for investors, we are ready to put this year behind us. All of that said, we are looking at a little change for the open here this morning ahead of what still is going to be a pretty busy week in terms of some earnings still trickling through and some economic data trickling through as well. So there's the opening bell here on this Monday morning with the holidays upon us. Hanukkah began last night. Happy Hanukkah
Thank you.
to everyone who celebrates.
You as well. I'm looking at Master Brand. Looks like a brand that I may want to shop. Hopefully it's a retail brand.
What?
Okay.
Cabinets?
I don't know.
Cabinets, yeah, cabinets.
Okay, Master Brand cabinets. Are you in the market for you have a nice kitchen.
I do. I mean, they've been around for 7 years. Good for them, getting some play on the New York Stock Exchange.
Good for them indeed. All right, Brad is checking out what's going on the Wi-Fi Interactive over there. Brad, you doing okay there as we get underway this morning?
I was just waiting for some things to calibrate so that we could put together a full view of what's going on for our viewers here. So taking a look at the Dow out the gate, flat, but barely to the upside here. Let's take a look at the year to date. How about that? Because we're going to be entering into some low volume periods as traders get some of the vacation. Of course, that could lead to some volatility, some volatile swings. Not here today. We're just kind of muddling along here. Flat to the downside now for the Dow Jones Industrial Average. So you've got the early makings of a waffle activity there. And then additionally here, checking in on the Nasdaq Composite. Let's take a look at that major average for the tech heavy average. You're seeing that flat, just barely to the downside as well. S&P 500, same case there. I sound like a broken record, but let's check in on some of the sectors. Perhaps we got some interesting activity playing out there. As of right now, you've got more laggards than advancers, really just energy, and now you've got some entrance into that party, the positive gains party, with materials flat, barely to the upside, and financials deciding to get in on the chat too. So all in, you're seeing communication services actually move lower by about 0.7%, bringing up the caboose caboose here. We're going to break down some deal activity that's taking place in that sector in just a hot second. And then lastly here, I did want to take a look at some of the travel names as we've seen for TSA travel throughput numbers. I noted down that we had seen 2.35 million people travel over this weekend, yesterday actually, to really kick off some of that holiday travel. And so keep a close eye on some of the airline names. You have also got a deal between United Airlines and Mesa Airlines for regional flights. That is, they move away from their previous partner, which was American Airlines. And so American Airlines are seeing them actually fractionally higher right now by about 0.3%, while United Airlines is up by about 0.6%. So we'll keep a close eye on everything from the booking names all the way into the hotel, the travel and accommodation space. Going to be interesting to watch over the course of this week as we see even more of those throughput numbers giving us some kind of real-time insight into how people are moving about the country this holiday season.
Yeah, we always have our anecdata as well. I think you're the only one of the three of us who is going to be getting on a plane in the next week or so. Yes.
Spirit, right?
No.
Maybe the rest of us will be getting in some vehicles, although I won't be traveling far. We'll discuss our holiday plans more later. But now let's check in shares of Moderna. Those shares are on the move higher this morning by about 5%. They were upgraded to buy over at Jefferies. Michael Yee over there expecting a 2023 turnaround led by the drug maker's personalized cancer vaccine that's already had some success in trial runs. Jefferies also raising its price target on Moderna from 170 to 275. We talked to Michael Yee, I believe it was just last week, about his outlook for biotech for next year. And certainly that study data that Moderna just came out with in cooperation with Merck, when its cancer vaccine is used in cooperation with Keytruda, showing some progress there. So it looks like the street is potentially looking for big things from Moderna going into 2023.
Moderna, now one of the hottest, I would say, stocks in the market, up almost 48% in the past 3 months. I'm looking at a nifty Yahoo Finance chart. And just more on this upgrade, I encourage everyone to go to our senior healthcare reporter, Anjali Kamlani's her author page on Yahoo Finance. She just talked to Stefan Bancel last week about this new drug. Just a very fascinating watch, and it helps explain why you saw this upgrade and you might see some more coming soon.
Oh yeah, there's going to be a lot of movement, at least on the coverage side, especially within the healthcare and the biotech space, because there's been so much in the R&D that's come up to this point, especially around messenger mRNA, or messenger RNA, excuse me. mRNA, of course, the ticker symbol for Moderna, but it also is representative of that messenger RNA technology. And that really proves, or at least provides, a pathway for a lot of other solutions that they can get to on the treatment front. And one of those was, of course, critical in making sure that we had a viable vaccine candidate coming from Moderna as well over the course of the pandemic, and to really treat coronavirus as well to the best of its ability. And so with that in mind, Moderna, some of the other names that we've seen, a lot of deal-making activity either to kind of stave off against some of the unwinding of patents. We've seen that within Merck. We've seen that also within Pfizer too. And so Anjali has been doing a great job getting some of those CEOs on the record as well about what that pathway looks like going forward. Let's also check in on a few telecommunications companies, as shares of Verizon as well as AT&T, they're moving this morning. This is following a 2023 outlook from MoffettNathanson showing an upgrade to market perform from underperform for Verizon, and downgrading AT&T to underperform from market perform. We're taking a look at shares of both. Verizon is higher by about 0.4%. AT&T down right now by about 1.5%. And this is just something that they do cyclically, looking back over the past year and then trying to refresh some of the theme perspectives that they have. But this moving shares of both of those telecoms companies.
Yeah, small nuance for me. On the bottom of this report, you have another, I would say, research shop highlighting T-Mobile and the really strong year they have had. They're saying T-Mobile, once again, looks like the industry's most attractive investment. That continues to be the vibe on Wall Street when it comes to telecoms. Of course, T-Mobile got some really great spectrum from the acquisition of Sprint. They have also just cut a lot of expenses out this business. CEO Mike Sievert just operating a lot faster than some of his competitors. Well,
and so it's interesting here because Craig Moffett over there at SVB MoffettNathanson saying that it is not their sort of fundamental views of these companies have not changed. They've liked T-Mobile, and they've thought that AT&T and Verizon were weaker. It's just a matter of what the stocks have done. So they, in their view, AT&T has outperformed, sort of unjustifiably so, and Verizon has been hit, perhaps maybe unjustifiably so, or too much given, even though its outlook is sort of anemic, maybe it's down too much. So it seems to be mostly a valuation call that they're making on AT&T and Verizon specifically, even as they're still positive on T-Mobile.
You have AT&T. A large reason why it has done pretty well this year is they no longer have those media assets. They dumped that over in Discovery, and look at all the write-downs they're now seeing. So their cost base has really improved this year.
Yeah, but the fundamental business is still
they're still selling phones.
kind of meh thing.
Well, we'll see what part of the cycle that we're at, and people buying phones out there and starting up some of those new plans. Perhaps we'll get a better insight after the holiday season once we see how many of those new devices have been worked through as well. Also coming up on the other side of this short break, everyone, Yahoo Finance's Jared Blickery going to join us in studio to break down the latest market action after the market saw back-to-back weekly losses. That's next. Welcome back to Yahoo Finance Live. Major averages here in the U.S. trying to make up their mind out the gate on this trading week, this new trading week in the holiday season. Let's get to Yahoo Finance's Jared Blickery at the Wi-Fi Interactive for more on today's tape. Jared.
All right. Well, don't count the market out this week. We still got a lot to handle. And usually it is kind of unusual that the Christmas week, we do actually have 5 days of trading. So let's go through what we're looking at right now. Dow down just slightly, S&P 500 about treading water, Nasdaq down about 0.33%. Let's check out the sector action, and we can see here energy, that is in the forefront. That's up 0.6%, followed by industrials, financials, staples, utilities. So interesting mix of the value and then some of the more defensive plays right here. That's what's in the green today. And then to the downside, communication services, that's down 0.7%. And let me just focus on the broader market for a second. Then we got some stuff to dig into with respect to China. First, I want to show you the S&P 500. Here is a 6-month chart. Now, we have been bouncing around in this trading range for several weeks, in fact, over a month, and now we have broken below. So that probably is not the best construction for a Santa Claus rally, but who knows? Anything can happen. In fact, that's supposed to take effect, kick in later this week, so not even right now. Just checking in on some of the moves that we're seeing in the bond market. 8 basis points to the upside is a fairly large move, but still within the recent range, so I'm not going to make too much of that. So without further ado, let's go to the China stocks here, and something that kind of flew under the radar last week. There was a 2-day economic symposium that wrapped up, and President Xi made some statements, and they were echoed over the weekend, some of the communist papers. And so I think the bottom line is they are going to focus on consumption, and they're also going to be stimulating their economy there and the private sector in ways they have not done for years. So over the last 2 months, this has been a leading sector. Here's some of the price action of the components of the Nasdaq Golden Dragon Index, and you can see what a tear they've been on. Now, is this the all clear for the entire sector? I don't think so, but I have noticed that this is a marked change in tone for what has been a government that's very hostile to capital markets over the last few years, guys.
Jared Blickery, top analysis always. Appreciate it. All right, more than half of investors under the age of 35 years old get their investing advice from YouTube, according to a new report from FINRA. You can see on the chart right there. The next place this group gets their investing advice from is, you guessed it, Reddit. Our dear friend and senior editor, Miles Udland, flagging these stats to us. Thank you so much, Miles Udland. All right, coming up straight ahead, one investment bank is saying 2023 could also be very challenging for Snap. We'll have the analyst making that call next.
Been a tough year for Snap, down over 80% year to date. Our next guest says the social media company still faces some headwinds to come in 2023, including privacy changes and increased competition. Jefferies Vice President James Heaney joining us now. James, it's interesting in your note because you look at the overall advertising landscape and say, maybe the street is still too optimistic, which feels like a lot considering that something like Snap is down so much already this year. What do you think people are still not sort of getting about the advertising environment?
Great. Thank you so much for having me on. Right. Like you look at the estimates for next year, Snap, people are still looking for 9% revenue growth. And ultimately, we think it's more like 2% or potentially even worse in a bear case scenario. So there's really three things that we think people are missing. First of all, our economists at Jefferies think we're heading into a recession in the third quarter of 23. which could potentially last through the third quarter of 24. And ultimately, if they're right, we're likely nowhere near the bottom, just in terms of how bad the business can get. All you need to do is look back at what happened to Google during the global financial crisis. I mean, revenue growth went from 40% to just 3% in a few quarters. And we're not even in a recession yet. And Snap's growth has gone from over 50% to potentially zero in the quarter. So that's the first thing. Secondly, the Apple privacy changes, we think that those have just permanently impaired the quality of the advertising business. And we don't see Snap recovering from those changes anytime soon. And I think the third part is just, this is a company that does not generate positive earnings. And we don't think they're due to generate any earnings until 2027. And so investors just don't want to own unprofitable businesses, especially not in this higher rate, slower growth economy. And at the end of the day, we don't think Snap's dead. I mean, their daily users are still growing over 15%. So clearly a super relevant platform to the younger demographic. And we see big opportunities in augmented reality, the map. So we do think for longer term investors, this story has promise. But in the near term, we just think it's due for some choppy waters.
And one of the other names that you cover as well, the Trade Desk, this is a company that is really trying to lean on the number of different platforms that are shifting over to streaming as a service, but with a subscription or ad tier model as well. Where does that provide some type of leg forward, at least in the absence of the digital advertising play that they've had for years now? And as we're seeing Netflix and really Disney, their partnership with Disney being touted among some investors out there over the summer.
Sure. I mean, the Trade Desk is definitely one of the best fundamental stories in the internet, and that continues to be the case. So there's no real change there. I think the risk with Trade Desk is that a lot of investors already appreciate these tailwinds. I mean, people are looking for 20% growth in the business. And even after our investor conversations, we still think people are positioned for at least mid-teens growth. And again, like, the tailwinds are big, but if we're in a economic recession potentially, we just don't think those are reasonable estimates. And so I think that's really the risk. And at the same time, this stock trades at a pretty high multiple, still a double-digit revenue multiple or mid-30s on EBITDA. So this is not a cheap stock. And in the event that there's any downside risk and they have to revise lower, we think the stock could be in trouble. Obviously, lots of big tailwinds with the Netflix ad tier rolling out. And we do think that at some point Trade Desk could be selected as a partner, but we think that's already expected. So it's really just a valuation call. And we still think it's one of the better names in internet.
James, I want to go back to something you said on Snap, which was, to me, very striking. You don't expect them to have any profits until 2027. What happens if there's a recession next year? No profits for them until 2030?
No, I mean, so our base case now is that 2027 is when they turn a profit, and that is based on a more recessionary environment. So I think the street is a little bit more optimistic in terms of when Snap can become a profitable company. And yeah, I mean, look, advertising in general, a lot of these companies are quite profitable. And so we think investors will ultimately shift more dollars into stories like Meta that have some idiosyncratic catalysts, right? Like, they're trimming their expenses right now, and they laid off 13% of their workforce. And the core ad business there is still super profitable. So I think there's a narrative out there that Meta is just burning all their cash on the metaverse, when in reality, 80% of their operating expenses are actually going to the core business. So I think investors will focus more on profitable stories, and Meta or Snap, just does not fit that bill.
One of the stocks you do like is one that is not as well known, I feel like, in the space, and that's IAS, Integral Ad Sciences. Talk us through that one a little bit and why you think that they might do better than the rest of the space.
Yeah, so that company is an ad verification and measurement company. So essentially, anytime a large advertiser, let's just say, puts an ad on the Facebook newsfeed, their technology effectively tells you, was that ad seen by a real person in a brand safe environment? And ultimately, during a downturn, we think advertisers will shift towards services that help understand the return on investment for your advertisements. And so we think they have some idiosyncratic catalysts as well. So I mentioned the Facebook newsfeed. That's a new product that they're launching. They're also launching a product with Netflix to verify that the ads are seen on that platform. And the stock's cheap. It still trades at a 50% discount to its closest peer, DoubleVerify, which has a similar business. And so I think the combination of a relatively reasonable valuation multiple, and just idiosyncratic catalysts position that one quite well.
Do you see any kind of major impact or difference in the amount of time spent, especially on Snap, given the number of changes that they've made and trying to just make the platform more shoppable? And where does that kind of line up in your thesis and your purview?
It's a great question. I mean, as it relates to shopping on Snap, it's still pretty nascent in terms of where they are. I think the big promise for them is around augmented reality. And for anyone that's spent time on the Snap platform, I mean, the ability to sort of see how a shade of makeup looks on your face or how a sweatshirt fits on your body. Like, these are kind of unique differentiators. And I think it's what kind of draws people to the Snap platform. And overall, they have over 250 million people daily using augmented reality. So there's a great opportunity. The challenge, though, has been that they just haven't been able to convert this into an advertising opportunity. And so we think augmented reality is still less than 10% of the revenue, but might represent 90% of the long-term opportunity. So I think there's a lot of promise. It's just going to take time for them to realize a lot of these initiatives.
Yeah, a long time, I guess, in your view. James, thank you so much. Really interesting stuff. Jefferies Vice President James Heaney, appreciate it.
Thank you so much.
Thanks. Coming up, Nike earnings on tap. Sas is going to share his take on what investors should expect. That's next. Nike's earnings are out after the close of trading on Tuesday. The stage is set for another potential retail disappointment, maybe. Already, investors have gotten an earnings warning this month from VF Corp and a cautious holiday quarter guidance from Lululemon. Where does Nike fit into all of this? Saz has all the answers for us.
And of course, the standard disclosure, I am not picking any stocks or trades into earnings. I'm just breaking this stuff down for you guys. All right, first up, speaking of that, here's the trading setup on Nike, potentially. First up, earnings estimates have come down on Nike pretty considerably over the past 2 or 3 months. Makes sense. We have seen a lot of retail, Julie just mentioned, come out here and warn in recent weeks. Also, inventories throughout the sector remains very high. Lots of discounting. Not good for profit margins and earnings. Next up, expectations feel lower than other quarters this year. That's just my general sense of this setup here into this report. I think the prior 2 quarters, a lot of the folks on the street, a lot of analysts on the street were expecting Nike to be Nike, and some of those estimates have come down as their results have slowed up a little bit. Inventories have ballooned. But oddly, the stock has outperformed in December, outperforming the S&P 500. So a little bit of I would say, mixed vibes going into this Nike report on what may happen to the stock in terms of reaction the morning after they report. That would be Wednesday morning. Here is another graphic here. Why the quarter could be a letdown, though, for Nike. Good little nugget from Omar Saad over at Evercore ISI. 94% of Nike apparel SKUs, or essentially merchandise inventories, at Kohl's are currently on sale. That is definitely not something you often see for Nike or want to see in any stretch by any means. Next up, inventories, like I mentioned, are probably still elevated at Nike. They were coming out of the prior quarter, likely continue to be the case. Weak November U.S. retail sales, of course, that report last week hammered stocks. And then lastly, weak spending trends in China. Obviously, Nike is a big player in China for years, has relied on the country to drive its sales and profits, but that spending over there has been under pressure because of various COVID-related measures. My take, let Nike show you a good quarter. If you are inclined to trade this name, I think there will probably be ways to chase Nike stock if they do come out with something good. Let them prove to you that they're navigating this discretionary or this more discount-focused holiday shopping season before you jump into this name.
Yeah, I pointed out the website traffic trends and that being down month over month. I think this is also a big quarter that relies on basketball and that category doing well. And then you talk about the promotional period as well. In store, the focus, and I just got an email from them this morning around the 30% promotions that are still taking place. And that just goes to show you that they're even stretching out some of those discounts in their own facilities. Now, everything at Kohl's that they probably get of the Nike inventory is probably on sale because it's not like the Jordan 1s or not the best releases that they're getting, but it still is inventory markdowns that are considerable in terms of how Nike has positioned some of their direct-to-consumer strategy, and that's why they brought that back closer to the vest as well, too.
Yeah, the stores are awash in inventory.
You've got Nike basketball shoes on, right?
I did. I bought these last year. Went to the store, stood in line
Full price.
behind all of the sneakerheads, full price.
But
indeed.
you're probably not buying another pair this holiday season. Or maybe you are. I don't know.
I already did, yeah.
Oh, okay. There you go.
Got the same shoes in a different color, actually. Guys, coming up, why our next guest is warning of a volatile first half of 2023 to come for tech, and maybe they can answer why I bought the same shoes in a different color.
Because you're a stylish guy. That's why.
I appreciate it.
Welcome back to Yahoo Finance Live. I'm Brian Sozzi alongside Julie Hyman and Brad Smith. We're seeing some stability return to markets after last week's drubbing. Right now, all three major indices, we're seeing a little bit of a mixed action, I should say. Now we have teetered into the red, Dow down slightly, along with the S&P 500 and Nasdaq. Now here's what's on tap this hour. Big tech predictions. Baird analyst Ted Mortensen stops by with his top tech ideas for next year. A change of heart. Sam Bankman-Fried reportedly reverses course on extradition. Yahoo Finance's Alexis Keenan has the latest details on that. And diving for dollars, we'll talk to the CEO of a high-end submarine company that just landed billionaire money man Ray Dalio as an investor. Let's get over to Yahoo Finance and Inez Ferre over at the Wi-Fi Interactive. Inez, I wouldn't mind going in a submarine. I'm all for it. It sounds cool.
Oh, that sounds amazing, being a submarine. But Zoz, let's take a look at what's happening to the Nasdaq, which is a little bit underwater right now. It's down 0.8%. Part of this has to do with communication services and technology. I'll get to that in a second. But the S&P 500 down about 0.3%, and then the 10-year Treasury note up 10 basis points to 3.58%. Looking at the sectors, as I mentioned, communication services, technology, those are underwater. But you are looking at energy stocks, consumer staples that are in the green. Want to point out, when it comes to the energy stocks, we are looking at ExxonMobil up 0.9%. Piper Sandler picking ExxonMobil for its top 2023 pick. So that stock is higher. And I just want to show you what a year-to-date looks like for these energy-related stocks. Take a look. Double-digit percentages. ExxonMobil up to 72%. Chevron up 45% year-to-date. Over on the Dow, we are seeing Boeing, which is one of the leaders. JP Morgan also a leader as well. And then over on the Nasdaq 100, we've been watching the mega caps. We are seeing some analyst notes on some of these mega cap names. And then take a look at Tesla, up 1.7% after Elon Musk tweeting, hey, should he step down, resign from Twitter or not? Tesla's up right now.
All right, Yahoo Finance's own Inez Ferre will keep a close eye on shares of Tesla, given some of the Twitter activity from the Tesla CEO. Thanks so much. And it's been a wild ride for tech as the industry faces a wave of layoffs while geopolitical and economic headwinds weigh on investors' minds. And as we look ahead to the new year, our next guest says that a volatile first half is in store for 2023. With more on this, we are joined by Ted Mortensen, Baird Technology strategist. Ted, what particularly within tech do we have to look forward to in 2023?
Well, I think it's, as you indicated, and thanks for having me, I think it's going to be somewhat of a tough first half. And the reason why is not only are we facing some geopolitical headwinds, but the Fed with QT, I think that is one of the biggest issues that I think the street may not be getting their arms around. It's going to be higher for longer. That's number one. As you look at models out there, whether it be semiconductors or software, they're probably too high going into 23. And I think what has to happen is these managements have to gauge their commentary in the as we go into Q4 reports on really what's happening on the macroeconomic area on reality. And I think as those models come down and we actually understand what the earnings outlook is and what the revenues outlook is, we can get to more of a directional valuation that some of the large mutual funds as well as hedge funds can get their arms around and see what really reality is.
Well, and sort of on a related front, Ted, in a way, is the tightening cycle sort of helpful for investors because it allows them to see where the problem areas are, right? Because it's not as though tightening causes these issues, it sort of reveals them, right?
It does. And in this cycle, I think what you're seeing on, as you mentioned, what is being revealed, as in this cycle, the big are getting bigger. The cloud titans are now swimming out of their lanes, their product lanes. And platforms are winning in the marketplace as you pivot to these digital transformation macros, whether it be cloud, 5G, next generation security, and AI. The big is unfortunately getting bigger. And what it is alluding to is the smaller companies that have point solutions in this type of cycle, when you have negative economic headwinds, they become somewhat more at risk, and those models have more downside than some of the cloud titans would.
Ted, when did the semiconductor stocks bottom? They have not put up a good, I would say, past 6 months.
The problem, very simplistically, is 22 was illustrated by just-in-case inventory. And because we had so many acute supply chain issues, everybody's, the global 2000 that needed semiconductors are essentially building so much inventory. It looks as if we have to go through an inventory absorption cycle definitely in Q1. Inventories are very, very high out there. And as you enter 23, the big worry is that you have a unit recession. So to guess that the semiconductor index is going to come off the bottom in the first half, I don't think that's the right scenario. We really, really need to bleed some inventory here. And then I don't think anybody really has a very clear crystal ball based upon the macroeconomic areas to what degree we have a seasonal second half. So my best guess to answer the question directly, I think most investors that I'm talking to daily are looking at kind of this reassessment in April, May, or June to see how much inventory has been degraded. And then in semiconductors, there's commodity capacity plays, and then there's the innovators. And I think there's much more of a desire to own the innovators like an AMD, a NVIDIA, a name with huge backlog like a Avago, or to even some degree, the big leaders in high performance analog, and that would be an ADI.
Ted, I
with
think
very strong backlog.
Right. I think about the cloud-based software plays, software as a service, companies like Salesforce that have just been battered over the course of this year. What would you need to see within the environment for cloud companies, but SaaS or ERP specific companies to see some type of rebound next year?
This goes right back to the model as I opened up the conversation. We are now in front of what I would call a seat count compression. If you look at big tech, as of last week, we had roughly 90,000 layoffs in the Valley, from large, medium, and small companies. And as you look at SaaS, software as a service, their models are generally driven by seat count additions. And when you have layoffs, that generally doesn't really point to a lot of these companies outperforming. So for this group also to get going again, the models have to come down on these seat assumptions. Models have to be reset. And then post that, I think as you get realistic valuation, the models have bottomed. Investors will, when these models are de-risked a bit, I think you'll see some actual buyers more in the second half of next year.
Ted Mortensen, Baird technology strategist. Great analysis here. Happy holidays.
Okay, happy holidays for you.
Thanks.
Thank you.
Before we head to break, let's put a spotlight on what Guggenheim analyst Robert Durbel is calling a contrarian retail call for 2023. That would be Foot Locker, which Durbel sees as a buy. The longtime retail analyst says this: as new CEO Mary Dillon assembles her team, we believe the CFO appointment could act as a catalyst next year. Looking at the company's ability to generate and grow its free cash flow over the years, we believe Ms. Dillon will have sufficient financial support to execute the company's strategies. Straight ahead, Meta finds itself in hot water again with the EU. Julie has more on that and today's top headlines.
Let's get down to business now with some of the other headlines that we are watching this morning. There's another turn in the ongoing battle between the European Union and big tech. The bloc's executive arm escalating a probe into Meta, saying it's distorting competition in the market for classified ads. The EU says the company breached antitrust rules by unfairly tying the use of its ad service to the Facebook social network. Though only a preliminary view, Meta could face a fine of up to 10% of its annual global revenue. Last year, it brought in roughly $118 billion. Following the departure of CEO Steve Rendell and a full-year forecast downgrade, VF Corp is now exploring the sale of its JanSport backpack business. That's according to a report from Bloomberg. A deal could value the company at about $500 million, though it hasn't made a final decision on pursuing a sale. VF Corp, by the way, also owns Supreme, Vans, Timberland, and North Face. Stock is down over 60% so far this year, and it's not getting a boost from this report today. And Fortnite maker Epic Games has been fined $500 million by the FTC. The agency says the video game developer violated online privacy protections by collecting personal information from Fortnite players under the age of 13 without proper consent. The lawsuit also accuses the company of illegally enabling real-time voice and text chat communications for children. The agency adding Epic Games tricked players of all ages into making unintended purchases. Epic has not admitted or denied the FTC's allegations, but it will pay $245 million in consumer refunds to resolve the second of those complaints. Saz?
FTX founder Sam Bankman-Fried is reportedly set to surrender to extradition. Yahoo Finance legal correspondent Alexis Keenan has the latest on this. Alexis.
Hi, Brian. Yes, now Bankman-Fried expected not to fight the extradition to the U.S. that the U.S. authorities are requesting to face the Department of Justice's broad set, really, of 8 criminal charges that were unsealed on Tuesday. Those accuse Bankman-Fried of defrauding both customers, investors, as well as lenders to FTX and its other entities, and of campaign finance violations for U.S. laws. This is coming from Reuters. Reuters also reporting that Bankman-Fried is expected to appear for a hearing today in Nassau, Bahamas, to formally waive extradition. Now, if he does in fact do that, it instead means that he will be escorted to the United States to appear. He would have to appear in court in Manhattan within 2 days. He'd be asked to enter a plea. He would also be dealing with whether he would get bail or not. Prosecutors, of course, would be expected to say, no, he should remain in custody. He, in the other turn, would argue most likely that he should be able to be free on bail. That's something that the judge would have to consider. Now, what caused this about face after Bankman-Fried had planned to fight extradition? And mind you, those extradition fights, they can go on for a long time. They have gone well over a year in some cases. It could be that the conditions inside the prison are not tolerable. This is a prison where Bankman-Fried is being held in Bahamas. It's called Fox Hill. And recently in 2021, the U.S. State Department has cited the facility for things like overcrowding, as well as poor sanitation, supposedly rodent infested, prisoners using buckets for toilets. So not a great place to be spending time. The Bahamas has said they have since improved those conditions. But look, also during the week, we heard from FTX's now CEO, John Ray, testifying on Capitol Hill, characterizing Bankman-Fried's handling of customer funds as, quote, embezzlement. We also saw some court documents showing that FTX's digital market CEO or co-CEO, Ryan Salome, had warned regulators in the Bahamas about the questionable transfers going between FTX and the hedge fund that Bankman-Fried also ran, Alameda. But will Bahamas authorities, will their prosecutors also fight to keep Sam Bankman-Fried there locally? That's another question that reporters are asking. The authorities there, they still have a securities fraud investigation ongoing. Meanwhile, Bankman-Fried has said he does not believe he has criminal liability. So we're watching for that hearing today, and we'll bring you more as things unfold today. Brian and Julie?
And if I can jump in real quick, Alexis, when we think about the timing, how does that timing look different in the U.S. versus proceedings in the Bahamas as well?
Proceedings for the entire case? Is that what you're asking about, Brad? And sorry, I didn't mean to leave you out there.
No worries at all. Yes, that is what I'm asking about, though. For the entire case, given that some of that timing will have to align both with the U.S. and Bahamian authorities and figuring out who takes the prioritization in their own jurisdictions as well.
Well, if he does come back to the United States, the estimates from the lawyers that I've been talking to, criminal defense attorneys, as well as former prosecutors, they say a case like this, being as voluminous and complicated as it is, that they would expect it to go well over a year. I would not expect to see even a resolution in this case, not even getting to trial really for at least that amount of time. So I think a multi-year expectation is reasonable in this case. And then, as you mentioned, Bahamas authorities, they may want to get him to be in front of their courts as well at some point, pending the conclusion of their investigation.
All right, excellent analysis as always. A lot to keep tabs on. Our own Alexis Keenan tracking all of it for us with the FTX fallout. Thanks so much, Alexis. And coming up, what 2023 has in store for commodities. We're going to speak with an analyst from PIMCO. That's next. Welcome back. Inflation looks to weigh on consumers into 2023, but could a multi-asset portfolio provide a hedge against rising costs given projections for a commodities super cycle? Let's break that down for you. Joining now to discuss, we've got PIMCO portfolio manager and head of commodities, Greg Sher. Now, Greg, when you think about a commodities super cycle, what would that even look like in action?
Well, I think a super cycle, which is a tough term to specifically nail down, like we think 2023 has a very positive outlook for most commodities, driven by underinvestment and capital discipline that has frankly exceeded what I would have expected only a few years ago from particularly the U.S. energy patch, but also globally from the standpoint that the reinvestment of revenues and income into upstream hydrocarbon production in particular has been incredibly limited relative to what one would have expected historically. So when we look to 2023, we see capital discipline as being probably one of the underpinnings for a positive view on commodities in 2023. But the other underpinning in our mind is the reopening of China. If you look at 2022, it is remarkable how strong and how high commodity prices still are, with China acting as an actual headwind. Their oil demand contracted for the first time in 40 years. They're 1% of global oil demand, or 1 million barrels per day off of trend. And what we've seen in the developed markets as the economies have reopened, we've seen a surge in energy consumption. And I'm focusing on energy right now because energy is a critical input to the production and transportation of all other commodities as well. So I think 2023, while there's definite headwinds from rising interest rates and a slowdown in developed markets, China probably holds the key to the outlook for 2023. And if their reopening is successful, and the resurgence in travel as we expect it commences, the outlook for commodities is quite important, which, as you mentioned, is really important for investors who are looking to how to construct their portfolios.
And Greg, it's Julie here. I have to say, we've been focusing a lot on energy going into next year, too. And perhaps we've given a little bit of a short shrift to some of the other commodities. And I think of metals in particular when we're talking about China. Obviously, that's a big part of the picture, too. So do you expect sort of a similar demand opening for some of those commodities as well?
Certainly, China is a big weight in the metals markets. But when we look to 2023, are they going to be an industrial CapEx-led cycle, or is there going to be services? And given the previous investments in their industrial cycle has led to overcapacity in many industries, and we don't have expectations that the export demand will be particularly strong, we think the energy side will be the primary beneficiary, and metals will require a more global cycle to drive it to the next level. When we look at agriculture, that could actually be the sector that after energy that benefits the most, given agriculture is probably the sector with the least comfort and spare capacity in terms of inventories and days of coverage. So given the growing conditions in South America have not been great, given the growing conditions in the Midwest United States with drought are reducing our expected yields, agriculture might be the other sector that benefits most, and metals might be the one that lingers until there's a more virtuous manufacturing cycle globally.
Greg, how could the average investor trade or invest on some of these things you're putting forth?
Well, commodity indices are probably the best way of approaching it if you want the highest inflation beta, meaning the hedging properties of commodities delivers the best inflation beta of most asset classes. But there's also a more balanced approach that investors can look for. There's many multi-asset funds that are out there that will combine tips, commodities, maybe even REITs, and gold. And when we look to 2023, what we've seen in 2022 is that when inflation really is high and volatile, the portfolios that are, 60-40 portfolio does not get the natural diversification or the diversification one had hoped for. And then they find that the stocks and bonds are rising and falling together. And it really was inflation hedging assets, commodities in particular, that provided the diversification to portfolios. So we think investors are wise to look at inflation hedging solutions, given if inflation does exceed expectations, and certainly the forward curves for inflation are that the Fed will be successful in bringing it back down to target, within 2 years. If they're wrong and inflation is more sticky, inflation hedging assets are going to be critical because of the lack of diversification we've seen in the last year or two in a traditional 60-40 portfolio.
Certainly, these kinds of assets have benefited from that inflation hedging. I guess I'll take the other side of that. What if we do see inflation continue to come down and stabilize? Are these types of assets going to be less attractive for investors?
Well, I think that's why when you look at the forward curve, it is already pricing in a huge normalization, whether it be the five-year break evens, which we think of as a proxy for forward inflation expectations, or 2.1% CPI, which, after factoring the PC wedge to get to the favored Fed target, it's 180. I mean, that's pricing in a perfect execution on the Fed to slow inflation. And when we look at commodities, the forward prices are 5 to 10% below where prices are today. So when we look at the market, we think they're discounting success. So we think there's significant upside should inflation exceed, or should the capital underinvestment continue to be the primary driving force behind a lot of these markets in commodities.
PIMCO portfolio manager and commodities head Greg Shernow, great to see you. Have a happy rest of the holiday season.
Thank you very much.
Coming up, Yahoo Finance contributor Kevin Cirilli is here with the must-knows in D.C. for this week. We'll be right back. Far from a quiet holiday week in D.C., Yahoo Finance contributor Kevin Cirilli is here with a few things he is watching, starting with former President Donald Trump. Kevin.
This is the most consequential week for former President Donald Trump since he's left office. Later Monday afternoon, the House Select Committee on January 6th will meet to decide whether or not to refer any criminal or recommend to the Justice Department, rather, that there be any charges filed against former President Trump and some of his inner circle as it relates to January 6th. Separately, what we're also watching is that on Tuesday, the members of Congress will be meeting the House Ways and Means Committee about whether or not to release potentially some of the former president's tax returns. Remember that the former president has been entangled in New York court with regards to transparency over his tax records. This is something that Trump has kept incredibly close to vest for years, including during the 2016 presidential campaign and well into his administration. But now Democrats deciding whether or not to release any of those tax records. And it comes again as he's taken a hit in the polls as he's relaunched his bid for the White House.
And you're also watching another bit of drama in Washington as well. Kevin McCarthy reinvigorating his bid for speakership. What can we expect to see there?
Well, January 3rd is the big date for when Kevin McCarthy will have that vote on the House floor with Republicans voting whether or not to elect him the House Speaker. But it has been a tumultuous road for Kevin McCarthy and much more difficult than he would like. There are about 5 Republicans who are holding out support. And that means a lot when you look at the inner dynamics, Julie, of what Kevin McCarthy would need in order to get the gavel. I think it's really important to note that the hardliners on the right are not going to cave. And some of the more moderate members of the Republican Party who just maybe are supportive of McCarthy, if presented with another alternative on January 3rd, would they change their minds? It's made it an incredibly fascinating dynamic to watch. Again, because Republicans underperformed in the midterms, this has really weakened Kevin McCarthy and his grasp, so to speak, on a more clear path to the gavel. We'll see.
Kevin, it's really tough this morning because all I want to do is talk about the Eagles right now with you. But
yeah,
let's
right?
also talk first about something larger, just a little bit larger. The omnibus spending bill here. Do you think they can get that done this week?
Well, you know, we are 13-1, which is just an amazing thing. And if you're going to give me the inch, I'm going to take the mile. I'm having visions of Super Bowl for January. Maybe that's the real Christmas that's coming up. Back to work, Kevin Cirilli. I think they're going to pass the NDAA, $850 billion worth. The key sticking point in this is whether or not President Biden's going to get on board with it, because the Senate just passed a version that removes the vaccine mandate for members of the military. That John Kirby, who's a spokesperson for the national security in the White House, has been tight-lipped as to whether or not the president's going to get on board with that. Separately, they kicked the can, as we had discussed last week, for a week-long extension on keeping the government open. I do think they are going to ultimately pass that based on the conversations here in Washington, but it's a hefty chunk of change on these 2 pieces of legislation.
Kevin Cirilli, I have no commentary on the Eagles, but I appreciate you and Brad's enthusiasm. Thanks so much. Oh, Brad's flapping his wings over here. All right, thanks, guys. All right, it's the holiday season, of course. Investors are adjusting those budgets to pay for gifts or meals, but of course, rising costs might make saving and planning harder than expected. Joining us now for the steps to take to make sure you've properly addressed inflation in your financial plan is Sandy Brager, a certified financial planner and Chief Client Officer and Partner at Aspirant. Thank you so much for being here, Sandy. So obviously this is something that's very much on people's minds, especially as they're looking at prices this holiday season. So tell us what people can do, what steps they can take.
Yeah, Julie, the first step is to take a look at life insurance. Life insurance is talked about oftentimes as an income replacement tool, but it's not really. It helps provide resources to cover funding for VIPs in the event of an untimely death. And so when we work with our clients who are corporate executives, family business owners, and entrepreneurs, we're always taking a look at what their goals are. And oftentimes they have a goal related to caring for and supporting their family. And this means that in the event of an untimely death, they want to make sure there's resources available for funding. So let me give you a quick example. We're working with a young couple with 3 young kids. The wife is an executive. The husband is staying home with the kids because the wife is really, really busy. If something happened to her, they want to make sure that the husband has enough money to help raise those kids, fund all the things that they would have funded had she been living. And so we take a look at what those costs are in this rising inflation environment. Those costs have gotten a lot higher. And we're comparing the cost to what the couple has in terms of their financial resources today. And because there's a gap, we're filling it with life insurance. The same is true if something happened to the husband in this scenario, because if he died, the wife would want to take some time off to be with the kids, but she'd ultimately want to go back to work and she'd need some more childcare. So we're looking at both sides of the equation for this particular couple. And we think that folks should be looking at their goals. And if survivor support is an important goal of yours, make sure you're looking at life insurance to make sure your coverage is adequate in this high inflation environment we're in today.
Within this high inflation environment that we are in, I mean, where should people be looking to kind of cut back on expenses, or should it just be kind of a blanket reduction in some of their financial planning that they look to do with the rate of not just inflation, but where their income measures up to that, where other kind of the financial considerations at a household really come into play?
Brad, when it comes to spending, we think people should be looking at what different categories they're spending and how those categories line up with their values, what's most important to them. I'll give you an example. I'm working with a client who I met with last week. He's on a budget. He's wanting to stretch his resources for the rest of his life so he doesn't have to go back to work. And he was shocked when we were looking at year-to-date spending because he had exceeded his budget by so much. So we took a look at the different categories and we overlaid that with what's most important to him. For this particular individual, spending time with family and friends is really important. He's an adventurer. He likes to travel. He often pairs spending time with family and friends with his travel. So when we were looking at his expenses to try to get him closer to budget in 2023, the first thing he decided to do was cut out some expensive club memberships that he has. Those club memberships have been fruitful for him. He's enjoyed them, but they're not the most important thing. And that was an easy area for him to cut back on. He also wanted to spend time traveling again in 2023 with friends and family, but he's going to do it differently. Instead of traveling to new cities and meeting friends there, he's going to travel more often to visit friends and families in their location, invite them to see him, and he's going to spend a little bit more time preparing in advance for his international travel. With a strong dollar, it's going a lot further, and he wants to make sure he's targeting countries where he can stretch that out and really get back into his budget. And so when we find that taking this values approach to budgeting helps people really find power and confidence in their financial circumstances. We think that's really important in times like this when the economy is in flux, and so are investment markets.
Sandy, I want to go back to her talking a little bit about life insurance. In this inflationary environment, are there some do's and don'ts when picking a coverage plan?
So you want to make sure, again, as I was mentioning, Brian, that you have all of the goals that you want covered, but you need to make sure that the coverage is affordable within your plan. So you want to make sure you're really taking a look at what are your financial resources today in the event of a contingency. If you're looking at life insurance, you want to look at all the different types of policies that are out there and find the one that best fits your needs. One thing that we like to do with clients is stack life insurance policies. So if a client needs $1.5 million of insurance, rather than buying one $1.5 million policy, we're buying 3 $500,000 policies, maybe with different terms. That allows the client to reduce the overall cost of that life insurance package, but meet their expected needs for funding for their survivors if there were an untimely death were to occur.
Sandy, really important, obviously a somber conversation, but an important one, obviously, for people to have. Thank you so much for being here. Sandy Brager, Aspiriant Chief Client Officer and Partner. Thanks.
Thank you.
Coming up, the company that's underwater, even after big investments from Ray Dalio and James Cameron. Underwater, literally. A deep dive up next.
Under the sea.
We turn now to a company that's having a great day when it's plunging to new depths. Triton Submarines, the Florida company that built submersibles famous for exploring the Titanic's wreckage and the Mariana Trench, gaining two new owners, investors, who have recently purchased equity stakes. We're talking about hedge fund manager Ray Dalio and filmmaker James Cameron. The terms were not disclosed, but they come as the submaker pushes into the luxury market. Joining us now with more is Patrick Leahy. He's Triton Submarines co-founder and president, and an avid explorer himself. Patrick, thank you so much for being here. I have to say, we're all pretty fascinated by the idea of sort of leisure submarines, but I know some of your business is also to the research community, for example. But what does this new investment mean for Triton?
Well, it's a great opportunity for three people who share a common passion for the ocean to collectively think about what we can do in the future to supercharge the efforts of the company. So our goal is to enhance our ability to explore the ocean, to learn about it, and then to document it so that we can share this information with the larger human family. I can't imagine two people better to assist me in that way than James Cameron and Ray Dalio. Both of them are passionate, ardent sort of ocean advocates. They're very accomplished in their own right. And as I say, they're kindred spirits. They're people who love the ocean as I do.
Patrick, if I was interested in buying, let's say, a base model of this, how much does this cost and how long does it take to build one of these?
Well, it's a great question. Our products, there's about 15 models that we have in our product range. They range from about $2.5 million all the way up to about $40 million. The majority of our models are located in the $4 to $7.5 million range. It takes us anywhere from 12 to 24 months to deliver a sub. We've delivered 25 subs to date, and we have 5 under construction. Right now, we're building about 5 to 6 a year, and we hope that by this time next year or the year after, we'll be building 10 to 12 subs per year.
Who is your ideal customer, and who, as you continue to build out the business even more so, would you like to see get attracted to Triton brand, but also the range of products that you're building and constructing too?
Well, I don't know if I have an ideal customer, but our customer base seems to be focused primarily on private yacht owners. So people who have a vessel that has the capacity to launch and recover and support a submersible, and an owner with enough interest to invest that amount of capital in a machine that allows them to explore the ocean. What's interesting is the subs, while they're used often for recreation, just to go down and explore and see a part of our world you simply couldn't visit any other way. Many of our customers, and Ray Dalio and OceanX are probably one of the best examples, become inspired by the things they see, and they recognize the potential that these vehicles have to excite other people, and that the subs can be fitted and equipped with tools and equipment that enhance their ability as an exploration tool, as a scientific tool, as a filmmaking platform, where you can go down and do legitimate science, and then you can film that and then share it with others, as Ray and Ocean X have done so effectively in the last 12 years that we've been working together with him.
And Patrick, on that front as well, how much of your market is pure research? What percentage of your submarines go to research facilities and organizations?
Well, unfortunately, the research facilities and organizations simply don't have the financial wherewithal to buy subs. So what's happening instead, and this is really what we see as a really exciting trend, is yacht owners who are buying them are embracing the idea that they can be used as a bona fide scientific tool, and they're making them available to scientists and scientific organizations, and essentially funding science research and science expeditions, exploration initiatives, filming projects, and so on, because the science organizations themselves simply don't have the resources to acquire these vehicles or to support them.
That is pretty cool, though, that the owners are letting their vehicles be used for that. It's interesting as you talk, Patrick, because there's been such an upsurge in interest in the past few years in commercial space exploration, which is still in the nascent stages. And yet here you have something which is already available, right? And so I'm wondering how you think about the two together, right? Or how you do you think of this as sort of a competition for that, or in terms of your clients and what their interests are, and where are we in the sea exploration cycle versus the space exploration cycle?
Well, that's an excellent question, because it's something that's always baffled me, this fixation on space, rather than an interest in exploring the part of our world that we know so little about. Which I think is far more interesting. And as Ray said, you're going to see fantastic things every time you get in a submersible and you go underwater. I don't think it's a competition so much as the things are really complementary. If you're, an adventurous person, an explorer at heart, the idea of going into space, you can imagine why that would be alluring. In fact, it's interesting, at our Christmas party on Friday, I was talking about the fact that we had not one, not two, but three of our clients that went into space this year. And why did they go into space? Well, one, because they can afford to, I suppose, but two, because these are people that are interested in exploration. They're curious. They want to learn more. And so the opportunity to go to space is kind of a natural extension of that. But so too is the idea of visiting the ocean, because, and I think this is one of the reasons our products resonate in such a broad audience now, because people recognize that every time you get into a submersible and you make a dive and you go beyond the sort of typical diving limit of 30, 40, maybe 50 meters, you're likely seeing a part of our world that nobody has seen before. And that, I think, is pretty exciting. The chance to be a legitimate explorer, the chance to see something that maybe nobody has ever seen before. It's fantastic.
Patrick, I have two just quick questions for you. First is with regard to the number of different kind of apparatuses and submarines that you're looking to sell. When you think about this client base and how many of those you're anticipating to sell over the next few years, based on what you've already sold, what does that forecast look like?
Well, I think the forecast, it looks better than ever, because we have something like 800 yachts under construction. Mm-hmm. And although not all of those yacht owners are going to be, and that's just right now, but not all those yacht owners are going to be interested in having a submersible, it seems like more and more people are recognizing that a submersible enhances the ownership experience of a yacht by allowing you to, and by you, your guests, your friends, your family members, to visit an extraordinary part of our world and to see things that are memorable and that are going to have a huge impact. One of the things about a human occupied vehicle, and it's important to remember that the subs that we build, the craft that we manufacture, are human occupied vehicles, mm-hmm. also known as submersibles. there's something magical that happens when you dive in a sub. You know, you go underwater and you see this part of our world that is so beautiful that you, in most cases, had no idea what it looked like. If you want to create advocacy, if you want to create excitement about the ocean, that's a great way to do it.
And then,
well, not every, yeah, go ahead, sorry.
Yeah, no, we got to go, Patrick, but it's well documented that I have an aversion to the color yellow. So can you paint mine in a different color? Should I be able to purchase
Absolutely.
one?
We paint them all sorts of colors. We've delivered a sub that was Tiffany blue. We've got one in the shop right now that's silver. Another one that's completely black, non-skid. You know, it's got a beautiful interior that's being made right now in France. So we're excited by the possibility that we can now build a pretty interesting assortment of vehicles that can carry larger and larger numbers of people that are capable of going much deeper. So we can go all the way from a single person vehicle to one that carries as many as 66, and from diving depths of 100 meters or 330 feet to 11,000 meters or 36,000 feet. That's full ocean depth. That's as deep as you can go in the ocean.
Patrick, it's great to have you on the show, and it's great to hear that you're amenable to the color. We appreciate the time here. Trident Submarines President Patrick Leahy joining us here today.
Thank
Thanks
you
so
very much.
Absolutely.
Really appreciate the opportunity to speak with you folks today.
Certainly. Happy holidays. Guys, coming up, Britain walking on eggshells over food inflation. Yeah, I didn't write it. We've got the details next.
I like it.
Welcome back, everyone. It's time for Cover Time. 2 stories, 1 minute each. We'll zoom through and start with this. Inflation in the UK and Britain is forcing cracks in a key food staple for the country, eggs, with farmers saying that they lose money on every box sold, leading to production cuts and supermarkets rationing sales. Also, some reports of cracked eggs out there, too, really hitting on the egg prices, too.
Yeah, well, I mean, I would say unsurprising here. We've had concerns with the health of, flocks of chickens over there as well, but also, too, here in the U.S. We've been dealing with egg inflation pretty much throughout the whole year. But cracked eggs are no good eggs.
Yeah, I'm trying to look at the prices there in this video that we're showing to see how they compare to some of the prices that we've seen in the U.S. I know that you have been very $1.
That looks cheap. I mean, to me, that looks cheap.
Or £1.89, I should say.
Yeah.
Well, double that, and that was for half a dozen.
Yeah.
So that's not really cheap.
I pay, I think, $7 or $8 for a dozen eggs at Whole Foods over the weekend. But I mean,
$7 or $8?
But it's like organic brown eggs. Like I feel better after eating.
Still, that is Oh,
I'm just buying my eyes. I said egg. They're like extra large eggs.
Yeah.
They're not the same size as like a baseball, but they're like really big eggs, and they're brown and they're organic, and I'm getting excited about them. I'll take a photo for you. All right, the penalty shootout heard around the world. The 2022 World Cup game took it to a dramatic conclusion in Qatar yesterday, marking the end to a record-breaking event that gave Argentina its first World Cup victory since 1986. And I think we've all been saying we've been mostly, at least for me, I tracked it on my phone when I was in the mall here, but an exciting conclusion here on what has been an exciting tournament.
Well, great news for Argentina. They're going to get all of that Budweiser. And they were, of course, the official beer of FIFA World Cup. And there was a ton of news around the fact that they couldn't sell it there on premise. And so now all that's going to get shipped to Argentina.
Right. And obviously this is a huge redemption arc for Lionel Messi as well, after he had previously quit the national team after not bringing home the cup before. So that's really interesting. It's also really interesting that despite the criticism of Qatar, that this has been, by and large, a successful World Cup for them. Yes, there's been controversy.
Yeah.
But it happened, right? They got all of this focus on
Elon
them.
got to go with Jared Kushner. He was photographed there yesterday.
Well, that was part of the
hanging out there, just enjoying himself.
Yeah, that might have been, All right. Coming up, Kiko Fujita and Rochelle Akufo are going to take you through the next hour of trading. And I will be back in the chair to speak with Grayscale Investment CEO Michael Sonnenschein, talking about his latest letter to investors. You don't want to miss that. We'll be back tomorrow.
I ain't missing it.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast and 8 a.m. on the West. I'm Rochelle Akufo along with Kiko Fujita. Here's a look at what we're watching today. Crowdsourced decisions. Twitter users tell Elon Musk he should quit as CEO as his poll backfires or succeeds, I guess depending on how you look at it. Now, was this all part of a grand plan to step aside? We'll discuss with Ross Gerber. coming up. And counterweight, China's leadership vows to boost consumption and focus on the economy in 2023. Now, that's usually a bullish signal for markets, but will it all be moot if COVID cases continue to tick higher? We take a look at the signs that things are much worse than reported. And regulatory roadblocks. We'll speak with crypto investment manager Grayscale as it battles the SEC over turning its giant Bitcoin trust into an ETF. CEO Michael Sonnenschein joins us this hour. You won't want to miss it. Right, first, let's take a look at how the major indices are trading this morning. We see all three in negative territory, but only slightly there. The Dow losing about just over 35 points. The S&P 500, they're down 0.5%. And the tech-heavy Nasdaq, though, having the biggest sell-off of the all three, down more than 1%. Let's also take a look at what we're seeing in the Treasury market today. We're seeing that those are in positive territory there. We're seeing that especially for the longer term bonds that we're looking at the 30-year, that's up about 3%, the 10-year up about 2.8%, and the 5-year up 2.5%.
Well, Rochelle, we are beginning this morning with Elon Musk in the spotlight after posting a Twitter poll where he asked users over the weekend whether or not he should step down as CEO of the social media giant, saying that he will abide by the result. Well, the people have spoken. You see right there, more than 17 million votes cast here, with a majority of respondents saying, yes, in fact, Musk should step down as head of Twitter. And Rochelle, we should point out there's no timeline here. He hasn't said when he will step down, if in fact he keeps his word that he's going to abide by the results here. But you could argue this is as much about Twitter as it is about Tesla. And I want to point to where shares of Tesla are moving today, because we have seen a pop there on the back of this poll, although it's down now about 1.2%. You look back to where Tesla stock has gone since the acquisition. You look at year to date, it's down nearly 60%. Elon Musk has been facing a lot of pressure from shareholders who have said he's simply too distracted to be leading Twitter and Tesla. You'd imagine this is kind of welcome news for those shareholders on the back of what was another event-filled, I think that's putting it lightly, weekend on Twitter there, with Elon Musk, of course, banning some of the, tech reporters, pretty high-profile ones, or suspending them, I should say, before reinstating their account. And then you had what happened on Sunday, which is essentially Twitter coming out and saying that they will no longer allow these accounts that promote other social media platforms, which also, kind of raised a fuss there.
I mean, this was really bubbling over, especially when Musk then sold even more shares after saying that he wouldn't. There were a lot of calls asking for the board of directors at Tesla to step in. A lot of shareholders very frustrated, venting their frustrations online, calling into question Musk's leadership. And as you mentioned, it was one thing when it was just Twitter was a distraction, but now this is a financial toll it's now taking on Tesla. And a lot of Tesla bulls still bullish on the company, but I think frustration really the key there. And when you think of what this means in terms of his leadership, when you look at what he did with Tesla and SpaceX, there was a grand vision about what he wanted to do, solve a global problem. Twitter is a completely different beast. So those skills have not translated into Twitter. We've seen a lot of back and forth, sort of trying this trial and error, trying to institute new things with the blue checks and ways to monetize it, and then having to reverse that because it became very unpopular and because of all the backlash. It's a very different leadership strategy, but at least this glimmer of hope, as we mentioned, we don't know when he's going to be stepping down or to what degree he'll honor this or what role he might still have at Twitter after this, but at least for Tesla stock, some welcome news.
Yeah, and to your point, it's a different skill set. And also, Tesla and SpaceX don't involve tweeting 24 hours a day in the early morning hours, kind of giving some, shareholders of Tesla a bit of a shock there. So let's keep the conversation going with our first guest for the hour. We've got Jeffrey Sonnenfeld. He is Senior Associate Dean for Leadership Studies at the Yale School of Management. Jeffrey, it seems perfect that we've got somebody who's focused on leadership studies to be talking about where Elon Musk has taken this company. I mean, your reaction here to what is essentially crowdsourcing the future of the company.
Thanks, Kira. I appreciate you laughing at the surprising relevance of my title for this topic. You're right, is in studying leadership, this is a guy who's stretched beyond the pale. I mean, it is without doubt, this has been an extraordinarily successful person. And the United States, the global economy was up till now better off with him on the planet than not so. We all have to admit that. And of course, he has succeeded by defying the cynics. But now, every now and then somebody grows beyond their capacity. That survey that you just showed of his Twitter poll is actually favorable compared to what we just did 3 days ago at our last CEO summit. Is we had 200 CEOs where 79% of them believe that he's actually become a detriment to the value of his brands. 69% say the best days of Twitter are behind it. Only 25% think that Twitter would be more valuable in 5 years, and that 98%, of course, feel that Musk has overpaid for Twitter, and 56% of them think advertisers should stop advertising there.
Now, it doesn't seem to be affecting his credibility when it comes to Tesla. That seemed to have already been established. But is there any kind of spillover given sort of the behavior that we've seen during his tenure at Twitter?
Well, Rochelle, I think you're right. He has been brilliant. His technology is, of course, not cutting edge, but it has been executed much better than the cynics thought in terms of EV. Now, his sensors for autonomous driving are where he is, again, not at the frontier. He is the next best technology but where is that fleet of 1 million autonomous taxis that were promised to be delivered 3 years ago? Not they were announced 3 years, they were announced 5 years ago, 4.5 years ago. They're supposed to be delivered 3 years ago. The world's largest automotive insurance company, never happened. Many of these promises from his strange diversions into leaf blowers and flamethrowers seem to be weird diversions, but Twitter is a major diversion. Being a CEO or in a senior role at 6 different companies is really hard to do. If he works the 12-hour day, which he claims he does, which we know he doesn't, or an 80-hour week with all of his clowning around, we know is not possible, but just giving him the benefit of the doubt, that's less than an hour and a half per company, 80 minutes per company. That's not reasonable oversight. So obviously he's stretched beyond his capacity. When has the Boring Company done except live up to its name? Where are those tunnels that are supposed to take us through all these different cities? So the fact that, as you guys pointed out, that his stock is down 60% in Tesla since he bought Twitter just shows some of the cost of his distraction in addition to his mercurial style.
Yeah, and Jeffrey, you could argue that he's kind of hinted at this himself in one of his many, many tweets where he said that, he doesn't plan to sort of stay on as CEO for Twitter. But I wonder if you think that this is, what kind of hit you think the Musk brand has taken as a result of his actions, his words, his tweets on Twitter. I mean, yes, Tesla, he built his credibility there, but you could argue there's some buyers out there who are saying, I don't know if I want this car now, given what we have heard from him on Twitter. I mean, are we making too much of that, or has that Musk brand taken a hit already?
Governing genius is always a challenge. We knew that Steve Jobs had his mercurial moments. There's nothing like this. When I would come on and we all of us would have this conversation, somebody like Larry Ellison, the great genius behind Oracle and friend of Elon Musk, would say, when's the last time you've taken a space capsule from 50,000 miles in the sky and landed into a 1 mile square area in the ocean? No, it's hard to do. And the SpaceX success and many of these things have been exceptional. But as we're looking at Tesla, we're seeing soaring complaints and consumer reports and into the government agencies about servicing issues, about quality issues with Tesla. We're obviously seeing there are sales issues, a lot of it having to do with his what he banked on was going to happen out of Shanghai, which of course with the lockdowns in China and production issues, we're not hitting expectations. But these were big bets that he met, and yes, the tolerance for hate speech has had a huge impact on his brand, and so it is no longer as glistening. As much as we would have celebrated his genius, we don't celebrate the rest. And certainly, a lot of my students look with askance about jobs at Tesla and buying Teslas. And I think that in terms of reaching we're looking at this skeptical generation rising right now that was once his big fan. I think that's a set of fans you're right. That's a big cost to the brand, and I think that's become problematic. It's become detrimental.
Well, as Musk tweeted, be careful what you wished for. Certainly a predicament he maybe didn't expect after
Well,
that one
Rochelle,
tweet.
there are some things that these Twitter polls are fake, that he has, I mean, they're pre-designed. He already has made a decision. He's trying to make it look like he's being responsive when his board has forced him out. Some tech titans tell me he wants to use the PayPal engine that he still owns to try to create an e-commerce site out of this. But if he's destroyed trust, he's destroying that possibility too.
Oh, to be inside the mind of Elon Musk. But we do thank you for breaking all of that down with us. Jeffrey Sonnenfeld, Senior Associate Dean for Leadership Studies at the Yale School of Management. And of course, we'll continue the conversation later this hour with Tesla investor Ross Gerber. You won't want to miss it. All right, let's head on over now to Yahoo Finance's Inez Ferrer for a check on what's happening with the market action. Hey, Inez.
Hey, Rochelle, and we are watching the Nasdaq, which is down about 1.2%, near the lows of the session right now. I do want to point out the U.S. dollar index that is seeing a bit of an uptick over the last half hour or so. So that's certainly putting pressure also on assets right now. We are watching the sectors and communication services, technology stocks. These have been the ones, consumer discretionary as well, that have been lagging. We are watching consumer staples, energy stocks in the green. Want to point out, when it comes to energy, ExxonMobil up about 0.5%. Piper Sandler picking ExxonMobil as a top pick for 2023. Year to date, the stock is up 72%. Over on the Nasdaq, we have been watching the mega caps. Despite some analyst calls about the mega caps, we are seeing these under pressure. You've got Amazon that's down more than 3%. Amazon was put as rated outperform by Evercore ISI, and also Nvidia down about 1.5%. A top pick over at Needham, with Needham analysts saying to buy the dip, guys.
And as I'm surprised you made it through the whole segment without making a reference to the World Cup. Big win for Argentina. I know you've been celebrating.
A huge win. I'll tell you, my entire family sending me videos, pictures from Buenos Aires. Everybody was so excited. I was extremely excited for Messi and the team.
Yeah, big weekend for you, obviously, and all the Argentina fans. Thanks so much for that, Inez.
Thank you.
Let's take a look at shares of Facebook's Meta here. It is under some pressure here in the session after the European Union charged the company with antitrust violations stemming from its online marketplace. Specifically, the EU's Executive Commission said Facebook shields competition from other ad services by tying its own Facebook marketplace to its social network. Now, the EU also alleged Meta imposes unfair trading conditions on rivals for, in their words, its own benefit. The charges follow years of investigations into the company. Meta has denied the allegations, saying the claims are, in their words, without foundation. The company adding in a statement that it will continue to work with regulatory authorities to demonstrate that its product innovation is pro-consumer and pro-competitive. And you see their shares down nearly 3% on the day. Well, coming up next, China's COVID-19 death count is coming into question as a Beijing crematorium remains overwhelmed with fatalities, despite China only reporting 2 new deaths in weeks. We're going to be back with the latest on that situation on the other side. We'll be right back. Well, for the first time in weeks, China reported more COVID-related deaths today. Data that comes as questions mount over whether or not the country's official count is actually capturing the full toll. Let's bring in Yahoo Finance's Anjali Kamlani. Anjali, there's some scary numbers floating out there about just what this death toll could ultimately look like, given that China has now, taken the foot off the pedal in terms of the zero COVID policy.
That's right, Akiko. We got some news over the weekend that there's potential that China is once again undercounting not just cases, but also deaths. This time, the official number at just a handful, while reporters on the ground have noted, especially those for Reuters and Bloomberg reporting, that there are dozens, if not more than, a dozen, if not more than that, bodies lined up at crematoriums, especially those designated to handle COVID-19 deaths. There's also a labor shortage, as you might expect 2 weeks after lifting restrictions. The transmission has definitely gone up, but we're not seeing those numbers on the charts. As you can see here, the deaths from February through April, that's really where the last surge hit the country. And even then, there were accusations and concerns that the country was not accounting for all deaths as well as all cases. We know that in the recent weeks, right before the restriction was lifted, cases were climbing, and we're still not seeing that kind of surge reflecting as it would in other countries. So experts are concerned that while projections look to the millions, there it's not quite captured in the official numbers yet, and no state officials have responded to requests for confirmation. Crematoriums are only confirming that they have workers out sick with the rise in cases, but not the number of COVID deaths. So it's really an unclear picture what's going on in the country right now.
And certainly some disturbing pictures as we were showing there outside the crematorium there. Anjali Kamlani, thanks so much. Well, as China returns to the forefront with Xi Jinping loosening the reins, our next guest has upgraded her global outlook, saying that this news out of China will lighten the downdraft for the world economic outlook. TD Bank Group Chief Economist and Senior Vice President Beata Karanzi joins us now. Welcome to the show. So, Beata, when you have this sort of backdrop of these rising cases in China, but also the loosening of zero COVID, how much is that changing the global outlook and the risks that still might lie ahead?
Yeah, I think you got to separate the time period. So I would say in the first quarter of next year, 2023, it's probably going to add some downside risks, to the point of your earlier segment that there's going to be some dislocation related to illnesses, health crisis, potential disruptions in the workplace being magnified relative to what we've seen recently under the controlled situation. However, we know from the experience of other countries, this is a fast-moving virus with a high R naught, and you have a period of time where it rises and comes back down. If it follows that same pattern, and you have a normalization of activity that can take place by the second and third quarter, this is a population that's had an incredible amount of weight placed on them, holding back expenditures, holding back investment. And so once that restraint is removed, there's a lot of pent-up demand that can come through. Slight problem in an environment globally where you're trying to tap down inflationary pressure. So it actually could be adding an inflationary risk in next year, especially on the commodity price side. But I would say that comes through around the second half of 2023 in particular. So in the near term, some downside risk, but overall for 2023, there could be a tailwind there.
Yeah, a tailwind in terms of the economic growth we're likely to see out of China, to your point on that pent-up demand. But I wonder if you can hone in a bit more on that inflation risk. I mean, how much more upside sounds positive, but how much more inflation pressure are we likely to see as a result of that increasing demand likely to come through from China in potentially the second half of the year?
Yeah, and then that question comes back to how everybody else is doing, right? Because Europe is certainly going to be in recession, and the U.S. should be hitting its low period in terms of its economic growth, with the pass-through of higher rates, really starting to bite consumption patterns at that stage. So there's a little bit of a balancing act happening, and we'll see how that all plays out. That's why it's a risk as opposed to embedded in our forecast at that time. But we got to keep it on our radar, because it certainly would suggest that anything that comes from other countries and ends up getting imported in the US through that price channel would not be great in an economy that's already looking at a 5% interest rate to cool down that job market and the price pressure. So it's going to be an added layer of complexity for the Fed if we get into that environment. If the global economy is so weak that even with China reentering, you have sufficient weakness elsewhere that you're netting out about the same place, then you may not see it transpire.
And Beata, you mentioned the Fed there. We know that they're still keeping an eye on this labor market resilience, still very, very tight. And you're forecasting a low and slow growth model for next year. Break that down for us.
Yeah, when you think about how to take inflationary pressures out of the US economy, there's really only two ways to do it. You either have a hard landing with almost like a V-shaped type recession, deep, but probably not prolonged, maybe 2 to 3 quarters, to squeeze out the wage and inflationary pressures. The other alternative is that you end up with the slow and low growth phase, which is, can be quite painful. It's a stagnant economy in terms of our forecast for a 2-year period that sees the unemployment rate steadily rise throughout that 2-year period, which is different from what the Federal Reserve is envisioning. They're envisioning only the unemployment rate rising through next year and then leveling off, whereas we continue to see it in our forecast push higher. Because the ultimately thing, in an environment where you have vacancy rates as high as they are and you have unemployment rate as low as you are, you're probably going to have to squeeze out more of those job pressures than they likely are anticipating. So we think at a minimum, you're looking at about 1 million job losses. Now, historically, that would be considered a mild recession. It's only mild to the people who don't lose their job, right? So that's our minimum threshold of what we're expecting in this slow and low growth period.
A lot to look ahead to in the coming year here. Beata Carranci, TD Bank Group Chief Economist and Senior Vice President. I appreciate your time today. Well, coming up, e-commerce stocks have taken a hit this year as inflation weighs on consumer spending habits. Is now a good time to buy, though? Citi Internet analyst Ygal Arounian is going to be joining us with his take after the break.
E-commerce names like Wish, Etsy, and Zillow all feeling the burn as consumers get pressured by all these rising costs. But have these and other e-commerce stocks gotten too cheap to ignore? Well, Citigroup Internet analyst Ygal Arounian joins us now to weigh in. So, Ygal, obviously a lot of different reasons. Zillow's reasons with the property market different from, say, an Etsy or a Wish. But who do you like right now?
Yeah, sure. So look, the e-commerce environment and retail in general, we're going to be going through a number of months here with a lot of question marks. We saw holiday spending come in a little bit better than expected, but there's still a lot of unanswered questions. So there's a couple of themes that we're looking to, particularly around e-commerce and really broadly around internet as well. And within our coverage, two of the e-commerce things that we like the most. One is Etsy, which has just been really such a high quality company. The gains that they've seen during COVID, they've really done a really good job of hanging on to. They've doubled their volume, they've doubled their buyers, and overall that platform has done a phenomenal job with a lot of room left to capture e-commerce share. The other name that we like right now, which is a little bit of a different story, is Wayfair. The top line and the macro is a little bit more challenging in their category in particular, but they've put some cost cut initiatives into place that should help them drive to profitability, EBITDA profitability, positive free cash flows as we work our way through next year. And that is something that I think investors can start to kind of hang their hats on a little bit as we work through some of the macro challenges.
Yigal, I realize that there's different narratives we're following with every one of these companies, but I wonder if we want to take sort of broader snapshot. When you look at the e-commerce space, when do you anticipate some of that bounce back to happen? I mean, you could argue that, consumers have been fairly resilient, but there is still some price pressure they're facing. What do you see when you go into next year?
Yeah, look, well, there's just a lot of variables around that question, and which way it ultimately breaks just depends on a number of things, right? The biggest of which is inflation, how inflation slows, how rates ultimately work with the Fed as we go through the year, and then employment and labor. So if we head into a recession where we're going to start to see more pressure on the labor market, higher on unemployment, you're going to start to see some continued pressure around discretionary spend. So you're right, there's been some resiliency so far, but I think a lot of that has to do with a strong labor market. So I think the kind of depth of how inflation flows through the rest of the year is going to be the biggest question mark for the consumer. And that's going to flow all the way through into how people spend as we work our way through the year.
And just quickly, Yigal, I know we've been taking a look at what's been happening with inventory for a lot of these e-tailers and retailers. Not seeing a lot of people when I go to the malls, not seeing a lot of people bustling and buying right now. How does the inventory story play going into 2023?
So inventory is different, especially within e-commerce and marketplaces in a lot of places, right? So Etsy, for example, doesn't have any inventory risk because it's a third-party marketplace. So that's a great thing that you bring up. I think that's a factor that you put in the positive camp for Etsy. Wayfair also doesn't have a lot of inventory. We are seeing the large retailers try to wind down their excess inventory, work their way through that. So that's something that takes time to play out as well. But that's something that can help support sales as well. One of the things that we've seen during the holiday period so far is that consumers have been really responsive to discounting. So as the retailers discount to clear out their inventory, that can help kind of spur sales to a certain extent as well. We clear our way through our inventory reset for next year as we work our way through. And so, we kind of balance out through the inventory. That helps with some discounts and pricing. And those things kind of balance themselves out. But again, I think the marketplaces that don't have inventory exposure right now, those are the ones that are the best position within internet e-commerce.
Yigal Arounian, it's good to see you again, Citigroup Internet Analyst joining us today. Well, coming up, as the FTX collapse continues to take a toll on the crypto landscape, Grayscale is preparing a backup plan if the SEC refuses to approve its spot Bitcoin ETF. CEO Michael Sonnenschein is going to be joining our very own Julie Hyman on the other side of the break.
Well, Grayscale Investments made headlines this morning after pledging to explore a tender offer for a portion of the shares of its Bitcoin fund should its conversion to an ETF not go through. Grayscale Investments CEO Michael Sonnenschein is joining me now to discuss. So this is a pretty big deal that you guys are doing this. So just to give viewers a little bit of history, you applied to the Securities and Exchange Commission to convert your trust into an ETF. That request was rejected earlier this year. You filed suit. So you're still pushing to get that done.
Yes.
So this is sort of a contingency plan, but talk to me about what's behind the decision and how it would work.
Well, so we have been focused on creating a Bitcoin ETF going all the way back to 2013. That's how we initially structured Grayscale Bitcoin Trust. It's always been our mission, and the full resources of the firm are still behind that initiative. We filed for a Bitcoin ETF in 2017. The SEC wasn't ready for it. GBTC has continued to grow and expand. It's now the world's largest Bitcoin investment vehicle. This past summer, the SEC denied our ETF application. To your point, we filed a lawsuit right away. And that's a reflection of us as a business. We're prepared for all outcomes. And so moving forward, even though, yes, now we are in the middle of litigation and we believe strongly in our arguments, they're common sense legal arguments that we think will be appealing to the courts. Ultimately, if we exhaust all of our options in the judicial system, we want our investors to know that we're prepared for that outcome as well and would explore a tender offer at that time.
And so the tender offer would effectively be that for 20% of shares, you would offer to buy them back.
The specifics of the tender offer would need SEC approval and shareholder approval. So it's tough to speculate on the exact mechanisms and exact pricing, but at this time we expect that it would be for up to 20% of the outstanding shares.
So acknowledging there's a lot of hypotheticals here, is this an acknowledgement that you might not win the suit and the spot Bitcoin ETF maybe will never be?
It is not an acknowledgement of that at all. We are steadfast in our belief, particularly in the wake of FTX, in the wake of all recent events in crypto. Now more than ever, investors deserve the protections and familiarities of a Bitcoin ETF. I certainly think that when you look at an asset, investment vehicle like GBTC, that is the largest in the world, it has, almost 1 million Americans that own GBTC. Why the SEC, why our regulators wouldn't take the opportunity to bring it closer into the regulatory perimeter seems like a really missed opportunity on their part, particularly in light of recent events.
Right. Be that as it may, it still might not happen if they don't agree. The other thing that potentially couldn't happen is, even for a tender offer, whatever the structure it might take, you need SEC approval for that too. So as you're making contingency plans, what's the contingency plan if the SEC doesn't approve a tender offer? Do you have another way to, give cash back to the people who are holding the trust?
Ultimately, an ETF, a spot Bitcoin ETF here in the US is a matter of when, not a matter of if. And so if there is no legal clarity, if there is no regulatory clarity, we will continue to pursue, the spot Bitcoin ETF, and eventually investors will get what they've been so patiently waiting for.
Okay, I know you've been pushing for this for a long time here. At the same time that all this is going on, there was an investor that filed a lawsuit against Grayscale called Furtree, which has called for more transparency and in particular wants a vehicle for investors to get redemptions, which is either what the Bitcoin ETF or the tender offer would also achieve. Why don't you currently allow redemptions? What in your structure, because it's self-imposed, right? It's not something that is regulatorily imposed upon you, if I'm understanding that correctly?
So GBTC briefly had a redemption program in 2014. The SEC deemed it to be in violation of Reg M. And at that time, as a result of that, we shut down the redemption program and have not been able to offer it since. So contrary to popular belief, it's as a result of that SEC shutdown. But I think when we zoom out, a lot of investors kind of conflate what we're actually doing in this lawsuit. What we're actually litigating for is the ability to do redemptions, right? We're litigating to have the ETF structure that has that built-in mechanism to both create and redeem and keep GBTC shares in line with its underlying net asset value.
Right, because right now they are not at all, right? You're at a big discount. Is there anything you can do to close that gap besides what you're talking about?
Well, I think in the environment that we're in, we've had a year where pretty much every risk asset has fallen precipitously in value. That's been true of tech stocks, certainly been true of crypto. And I think in the wake of recent events, there's a lot of mistrust in the system. And that is certainly putting a lot of sell pressure on GBTC, but a lot of assets as well. As we get into the end of the year here as well, I'm sure you'll also see some added pressure across markets, not just crypto or GBTC, but across all assets, with investors doing some tax loss harvesting as we get into the end of the year.
I mean, there's also concern because of the fallout from FTX, which then has spread to an entity also owned by your parent company, DGC. I'm talking about Genesis, which has a hole that it is now trying to fill. There's also concern about potential spillover for Grayscale, which again is under the same umbrella entity, although separate. What do you say to investors who are concerned about that?
You know, it's such a good question, Julia. I'm glad you bring it up because I addressed this in our letter, in the letter I put out to shareholders today. All of the assets underpinning our products are safe, secure, accounted for, and unencumbered. And it's important to know for investors that when you're a shareholder in any one of these products, those assets belong to that product, and you as a shareholder own the assets of that product. So these are separate and distinct entities that have no, direct tie or impacted by any other entities that are affiliated with Grayscale or anywhere under the DCG umbrella.
And you guys are under much more regulation than, say, an FTX or some of the other entities that have gotten into trouble as of late.
You know, I'm going to go as far as to say that we've been pioneers when it comes to regulation. We were the ones that proactively went to the SEC in a voluntary fashion, became the first SEC reporting company that was a digital currency investment product. We work constructively with regulators. We always have, we always will. And it's really been about defining with them full and fair disclosures, audited financials, coming up together with what the treatments, policies, definitions should be. And now, that's really the model for all other digital asset products that are coming into the market.
All of this said, you guys are linked to an asset that you don't control, right? It's not like your stock of a publicly traded company that you can manage through. What happens if Bitcoin never recovers?
Julie, I have been in crypto now for 9 years. And although there is a lot of mistrust in the system at the moment, I've never been more confident in the staying power of this asset class.
Really?
100%.
How so? Because the value of the asset is based upon the perception of its value. The perception now is pretty bad.
Mm-hmm. What would you say about tech stocks that have fallen 90% from their all-time highs? That are now, those companies are facing layoffs, they're, shedding business lines, et cetera. There's not a ton of confidence in them either.
No, but there's a use case there. They actually make stuff and do stuff, whereas Bitcoin, still, its use case, I think, is still questionable at this point.
Bitcoin has solidified at least one use case, and that's as digital gold. That is a narrative around Bitcoin that has been there, that will continue to be there. Ultimately, whether Bitcoin is able to achieve other use cases that are commonly known and commonly accepted as a payment rail or other use cases still yet to be determined, time will tell. But certainly the narrative around digital gold, non-sovereign assets, in an environment where a lot of people around the world are being directly harmed by the actions of their governments and the ways that they control their currencies, Bitcoin as a store of value, a digital gold for the digital age, is certainly a narrative that's here to stay.
As you say, time will tell. We really appreciate you coming in to talk to us about this, and we'll be in touch, obviously, as the lawsuit progresses and we get closer into next year. Thanks so much, Michael. Appreciate it. Grayscale Investment CEO Michael Sonnenschein. And coming up next, Tesla stock is on the move after Elon Musk gets voted out as Twitter CEO in a poll. We'll see if he actually steps down. Akiko and Rochelle speak to a man with skin in the game. That's Ross Gerber. He joins next.
Tesla shares briefly moved higher this morning since turning lower, though, and that's after Elon Musk polled followers asking if he should step down as Twitter CEO. Now, all this as multiple reports say Musk is approaching investors to help fund his purchase of Twitter, including Ross Gerber. Well, joining us now to discuss is Ross Gerber, Gerber Kawasaki Wealth Investment Management CEO. Ross, good to have you on the show. I know you've been very vocal about this roller coaster that especially Tesla stock has been on since Musk took this on. What are your expectations now? We saw a brief sort of shadow of hope, but back to reality we're seeing in the stock price right now.
Yeah, and as far as I'm concerned, the lower it goes, the better opportunity for investors as we're going to get resolution to this issue on, I hope, the short term. And that's what I'm working very hard for. And judging by Elon's comments, I think he is looking for a CEO now, and he just wants somebody who's going to make a very large commitment to doing it, and financially and emotionally and physically. So he has very high expectations on the way he wants Twitter to be run. And I think the end game has a little bit more focus now.
You could argue, Ross, you among many other investors and Tesla as well, certainly pressuring Elon Musk, who, you have said among many tweets that you just think this is unacceptable, that so much of the value from Tesla has been erased as a result of Elon's distraction with Twitter. I wonder what your bigger concern is here. Is it about the sale of his Tesla shares? Is it about the distraction? Is it about the brand dilution because of what he's been saying on the platform?
Well, it's really a combination of three things that have really bothered me, and that's why I've announced that I'm running for the board of Tesla. It's time for Tesla's board to wake up and do their job, because the job of a board is to protect shareholders and to provide guidance to people who want to invest in the company and have confidence in its future. And they've done nothing, absolutely nothing, a disgraceful nothing, not a word from anybody. So it's time for somebody to move over and let me be there, because I will do three things immediately. One is transparency. It's very important that we know what is the plan, either for secession of Tesla eventually, like if Elon died, what would be the secession plan? And then secondly, what is the current short-term plan for Tesla's management and bringing Elon back to Tesla, and what is the time frame for that? Number two, there needs to be transparency with the media. It needs to be very clear to people what's actually happening at Tesla, and Tesla's done a poor job of that since Elon stopped telling everybody what's happening at Tesla as he's focused on Twitter. And I would be doing weekly press conferences with the press, including tours of gigafactories for the mainstream media, so that people would be very informed on what's happening with Tesla, because it's such a really important time for them. And thirdly, I think it's crucially important that we end the stock sales or have transparency to what stock sales will or will not be happening into the future. If this is the end of the stock sales, then that should be that. And we need a standstill agreement with Mr. Musk so that he will not sell any more shares of Tesla, and that investors can have confidence in buying the stock and knowing they're not going to get whacked the next day with another $5 billion share sale. So those are the three things I'm most focused on, and bringing value back to Tesla and its shareholders as it goes into 2023, which will be a phenomenal year for the company.
And Ross, we know that Leo Koguan, who is the largest, the third largest individual shareholder in Tesla, he was saying, look, Musk is our employee. We don't actually need him there at Tesla. Do you agree? Would you still be as bullish about Tesla if Musk wasn't at the helm?
I disagree with Leo, and Leo is supporting me, and I support him, and I understand his anger and frustration with Elon at the moment, but that is not the best path for Tesla. The best path for Tesla is Elon Musk working full-time on building Cybertrucks, which is going to be an incredible challenge for Tesla this year as they ramp the production of a very highly complex vehicle using new materials and a new manufacturing process. Now, in my 8 years at Tesla, there's one thing I can guarantee: that ramp is for sure a big challenge, and Elon needs to be there every day in Austin making sure that this happens so I can get my Cybertruck this year.
Ross, finally, turning our attention back to Twitter, those reports that Elon Musk seeking new investors to buy in at $54.20 a share, which is what he bought Twitter at. You've confirmed those reports. You said you've been looking into client interest as well. What does that look like right now? And what's the path forward for this company?
Well, I think there are a large amount of investors that want to invest into Elon's Twitters, and we've received inbound interest from clients and non-clients even who want to invest in Twitter. So there are a lot of people who believe in this vision and want to be a part of it. So I don't think that's surprising. There was very little time for investors in the first round to actually raise money because it happened kind of in a night. So now they've given us maybe like 2 weeks, but at least I think it gives opportunity for other institutional and individual investors like the ones we represent to be involved with this investment. And I'm invested in it because I do believe over the long term this will be a good investment.
Really quickly, Ross, any particular names that pop up that could follow Elon over at Twitter?
Follow Elon, like to run it? I'd love to see John Ledger.
Replace him.
Yeah, I'd love to see John Ledger at T-Mobile. He used to run T-Mobile. He's been a friend, a wonderful CEO. He's great with media. He's great with advertisers. He's great with people and branding. And I think it would be great for Twitter. And what I think Elon needs is a great partner where he could be chief technology officer and focus on technology. And then you have a CEO media guy like John Ledger would be just amazing. It would be such a successful company, I think, with that kind of structure. And separating those tasks would be the correct action for Twitter.
Well, Ross, appreciate you hopping on the show today. Gerber Kawasaki co-founder and CEO Ross Gerber joining us there from LA. Well, coming up, the 2022 FIFA World Cup, not just a big win for Argentina. We're going to explain after the break. Well, Lionel Messi and Argentina won the 2022 FIFA World Cup by defeating France. Epic match if you missed it, while the country, along with its fans, celebrate the team. Some other winners emerge from the tournament. Its sponsors, from Adidas to McDonald's, and even the unused and unsold beers from Anheuser-Busch. World Cup sponsors scored over the past few weeks. Joining us now for more is Daniel Kelly, NYU School of Professional Studies academic director and professor. Professor, good to talk to you today. I guess you could sort of argue it was a big win for Qatar from a financial standpoint. Obviously, controversy follows. It wasn't necessarily about the money, but give me your assessment of where things stand now that everything is wrapped up.
With everything wrapped up with an amazing final between Argentina and France, Leo Messi was presented with a beast by the Emir, His Excellency Tamim bin Hamad Al Thani, which is the highest honor that any athlete can get or any person can get from in the Arab world. And so this kind of favor goes along with all of the accolades that Gianni Infantino, who is the leader of FIFA, the president, spoke about. Overall, since 2019 to yesterday, Qatar was able to earn $7.5 billion when it comes to revenue share that was earned during the time for the matches. And so overall, the games were fantastic. The sponsors were very pleased, and even Budweiser with the unsold beer will probably seek about 47 million in make good back from FIFA. But overall, I would say very happy with the investment in Qatar.
And they certainly got a shout out from Messi. He said, happy to celebrate and bring home the buds to all the fans that supported us. So at least a good finish after sort of getting blindsided by Qatar about not being able to serve beer at the games. Talk about some of the other big corporate winners, including FIFA itself.
FIFA is about $1 billion more than they made in Russia. So 6.5 billion in Russia, 7.5 billion in Qatar. The projection for 2026, when it moves over to the United States, to Canada, and to Mexico, is that they're on pace for 11 billion. So you're seeing the overall growth of the game and the overall growth of FIFA. Adidas itself expects the World Cup sales to around the world to top off at about 400 million euros to $421 million. McDonald's launched its largest global marketing campaign ever. And so what we're seeing is that the sponsors were investing. FIFA was strategic with a different grouping of sponsors, with the FIFA sponsors and the FIFA partners like Coca-Cola, Adidas, Visa, Qatar Airways, Qatar Energy, and Hyundai. And then, of course, their World Cup sponsors, including Budweiser, McDonald's, Mengyu Dairy, and Hisense. And so overall, just structuring their plan appropriately, but more importantly, making sure that they came through with the promises of a fantastic World Cup, which Argentina and France and Leo Messi and Kylian Mbappe definitely delivered.
Yeah, Qatar certainly very happy with those results there, given the bribery scandal that preceded what actually came through on the pitch there. But Daniel Kelly, good to talk to you today. Daniel Kelly, NYU School of Professional Studies Academic Director and Professor. Thanks so much for joining us today. Well, let's do a final check of the markets before we let you go. Investors still obviously very focused on the Fed here, although we are looking at this week leading up to the holidays. Obviously, Christmas coming up this weekend. The Dow down 85 points, the S&P 500 down 25, and the Nasdaq down 137. Tech continuing to lead the declines here, sort of an extension of what we saw during the week last week with those big sell-offs that followed the FOMC decision. We'll, of course, continue to monitor that. And the very latest at Twitter, you can certainly bet on that. That does it for myself and Rochelle Akufo. Appreciate you joining us today. We'll be right back here again tomorrow.
I don't. I thought it was going to be, it's not impromptu. I can quickly pop upstairs and print it off. Ah, okay.